Good morning, everybody. Um, hmm. Can we SLD today, please? I mean, today's only the first day of the supplementary liquidity deposit period, but maybe the market's reaction to what was pretty good PPI wasn't great. Although maybe they're worried that inflation is falling too fast on the producer side. It's a possibility. In before SLD even starts. Yeah. You know how it is. All right, let me make sure I have everything set up here because this is definitely fucked. All right, SPX. Ah, interesting. Well, that's dog shit. Okay. Hmm. Oh, because that's wrong. That's the wrong fucking setting entirely. Ah, you piece of shit. Um, Interesting. Okay. That's not working. Then maybe this is. Uh, uh, okay. Ding ding. Fuck man, I hate all of these. Is this any better? On. Curious. Okay. Let me switch this over to SPX. Fuck your puts, fuck your calls. Powell something something. My attention span is too short. Thank you, Nako. Give me 1 second. right. Buenos dias. Hello, solid separath. When you were late, things always run? Because you were early today. Does that mean ouchie downtowns? I don't I don't think that's how it works. It's not like the stock market waits to see like what side of the bed I wake up on and then makes all its decisions for the day based entirely on that. So speaking of SLD usually happens because entities sell their holdings to make the deposit, right? But if they've sold out of their holdings and not bought back in, mainly playing options, is that why we haven't seen much in the way of dramatic drops? Well, I think that's part of it. A small part of it. Generally, when they're selling holdings, they're selling out of their core positions. So those they're generally not going to get rid of even in the event of a crash, right? Because that's their marginable leverage, their collateral, or same as cash collateral. I do think that they have gone to some degree abroad to get margin, so that especially since the haircut from the DTCC that happened in late April. And then March, March with the bank failures, I think we didn't get an SLD in March because they pumped a shitload of money into the system, right? Then in April we kind of did, then we got the haircut, then in May we didn't, so we'll see how it plays out. You've still failed to address literally everything I brought up yesterday, Mount St. Funk. Building more houses and manufacturing more vehicles isn't going to happen when manufacturing is trying to reduce their footprint as much as feasibly possible because their growth has been contracting every month for the last 6 months, and their inventories are massively overstocked because consumer demand is drying up. What does that mean when people are going down too fast? Deflation? PPI going down too fast? Deflation? It could lead to that, yeah. I mean, it's definitely a sector where we're seeing a lot of pain in the employment rate. They ramped up production so much to meet COVID demand, and now that demand simply doesn't exist, right? So it could deflate faster. It is kind of already. There's a good chance that we'll hit deflation on the producer side while still remaining inflated on the consumer side. Have you ever looked at now before? The forward PE is more than Nvidia. I've been keeping an eye on it for a short. So yeah, they ripped ever since they announced their strategic partnership with Nvidia. When people are going down too fast, it's blowflation. What is this heart thing on the right of chat? I dislike it. I dislike it too, but it exists. I have no idea how to get rid of it. Headline numbers went down significantly beyond expectations. The market wasn't really sure if it was stoked about that. I mean, it's just more stagflationary data, right? Hitting deflation on the producer side. Meanwhile, don't forget that, manufacturing, everyone focuses on tech jobs and tech layoffs, right? But manufacturing represents 8.5% of this country's unemployment, or like 11.5 million jobs. every Fed report for the last 6 months has shown um contraction and growth across manufacturing and services, right? So, you know, we've got like the Philly, New York, Cleveland, like every single Fed report has shown contracting growth in manufacturing on the producer and producer side. So there's still jobs being lost that aren't making, you know, the front page of the New York Times. It's because we're all tech workers about to get fired. Fair enough, Bidhead. I won't argue that. It's different this time. Yeah. I think people very quickly forget that there are jobs in this country that aren't in the tech industry. And manufacturing is a huge part of our economy. And if the supply and manufacturing side of the economy contracts too sharply, while consumer demand is kind of just waning, um, that's going to present problems, probably, you know, equivalent to anything else that we were, you know, considering. So JPow's got he's got a tough decision to make today, because if he lets it slide, he risks moving into stagflation by the next GDP report, right? Also, you know, there's no guarantee that we're going to hit recession on the next unemployment report. We probably will, but it's not guaranteed, and he needs that to happen. So I know the odds are like 95 to 5, but they're probably closer to like 50-50. Super core inflation is also up, which is supposed to be their primary metric of determining forward inflation, as well as PCE, which is their forward looking indicator for inflation. No, I know tech doesn't employ everyone. They will just keep changing the definition of recession. They never changed the definition of recession. Okay? That's not what happened. We just weren't technically in one. So we avoided a technical recession by a report. Nvidia, 1 trillion market cap. Yep, totally reasonable. Fucking Ponzi scheme. Um, something recession sparkling wine. Something. A recession has to come from the recession region of France. I'm in manufacturing, and a weird thing that is happening is when we get a temp, they leave within 3 months without warning or reason. We've gone through 15 temps in 1 year at a 25-person facility. That's a lot. But, I mean, they are temps, right? There's no benefits. So they're probably just leaving for full-time work. I would say if it was full-time employees leaving, that might be a bigger issue. Hmm. Huh. Were you being facetious about me earning yields on my cash? What do you mean? I don't think so. Earning yields on cash is what this is all about. Are you talking about when I defined the risk of CSPs to you? When you asked me, can I just sell out of the money CSPs forever? There's risk in that. You can't just sell out of the money CSPs forever. This is why people don't actively manage, because there you're gonna run into a tail risk event, right? At some point, you're gonna get a big fat bag of shares that you don't want, right? And you're gonna be stuck with them forever. Now you can avoid that by only wheeling companies that you're willing to also own at the price that you're selling CSPs at. But that doesn't mean you're not wrong, right? Like, you could have been selling CSPs on target at 140, and now you'd be underwater. And then maybe for 2 years, it could be a very long time to you're able to make up that difference. Shit happens, right? So I told you spreads are arguably safer and they don't come with the risk of exposure and holding the underlying. And what you lose in upfront yield, you can make up for with leverage. Nasdaq ripping again? No. Interesting. Yeah, I mean, it's still up a lot though. Let's see. Oil's back above 70 a barrel again. Russell's still ripping, up 140 BPS this morning. But Dow down 0.43. VIX down a little, 9 cents from yesterday. I expect we'll see VIX increase a little today. Should probably keep an eye on it. Okay, so we've got some upstart calls. Didn't need anything else there? No. VIX. If upstart could chill, that'd be great. It would be. But it's not going to chill unless NASDAQ drops. If NASDAQ keeps pressuring the shorts, they're at a point now where they may capitulate. We're running out of call sellers to the upside. And if those call sellers decide to pull back their calls, or the put positions that are in the money close, why does everyone think a pause is coming when the Fed has nonstop said they will not stop hikes? Because the Fed suggested a pause. The candidate for the vice chair position announced in a meeting 2 weeks ago that they were thinking of doing a hawkish pause. And then I believe Williams corroborated that. All the other Fed presidents said that they thought a 0.25, two more 0.25 hikes up to a terminal rate of 5.6 were appropriate. Except for those two. Not a pause, a skip. It's the same shit, okay? Do you manually remove odd data like that? Sometimes those spikes that you're getting, are due to the data you're using, right? You can calculate the Greeks on your end, and that'll help a bit. Um, I don't think it's necessarily good to remove that data, but it's good to look at it both smooth and raw. Boy, that ghost pepper hurt my ass last night. I also refuse to press the heart button, but at the same time, I want to know what it does. I'm assuming it spams hearts in the bottom of chat. It's more of a skadoodle than a pause. Is the Fed normally this ambiguous? Well, they haven't been. Um, they've tried to be very transparent for the last 2 years in order to better control the narrative, right, and reduce speculation. But in doing that, they've shown their hand as being weak, and the market no longer respects their ability to significantly quantitatively tighten anything. Sometimes your actions have to speak louder than your words, and then the Fed hasn't really followed through with much. So do they all vote on it? Yes. It is a little like smoke and mirrors. I would probably not approach today's decision with any single direction position. SPX 52-week high. End times are here. Call your moms. If anyone's spamming hearts would please hit the like button, that would be great. Thanks, Nick. That's very hard to do when you're spamming the heart button. Not sure if you saw, but I think you can turn it off in stream settings. They're called reactions. Oh, okay. I like that. How do I... All right. Nice. I can get rid of their fucking stupid hearts. Don't you dare. I don't like them, okay? It makes me feel like a TikToker. And I'm not sure the point of them. Is it... It's very Hunger Gamesy. Like I'm supposed to create constant drama in order to keep people spamming the button or something. Stick a trident in Dork. Is he done? Would you put UNH in a similar group like Costco in the sense that boomers buy the dip hard? Yeah, it's pretty similar in that regard. From the guy who used a gladiator thumbnail. I mean, today's exciting. I don't know what you want from me. Requesting smoke and mirrors for a stream title. Buckle up, everybody. Thank you so much, regards, Geeky. I'll see what I can do. I made today's stream card. I think I did a great job. I don't know how to use Photoshop, which is very obvious. I love how the price of GME is solely based on fundamentals, right? A poll sometime today on FOMC decision. I guess we could. Yeah. Why not? I mean, it's not like the day's going to be super interesting until then. I've met Russell Crowe and I love that stream card. Is BTU breaking out? I don't know. Is it? A little bit. Back up at 20. So nice recovery from the bottom. Jonathan. I don't know. CRM's trading at a PE of 544. AMD is 546. Trade Desk is 513. FSLR is 500. Palo Alto Networks is 370. Chewy is 331. Amazon is 299. ServiceNow is 283. Nvidia is 213. Zoom is trading at 155. Jesus fuck. Tesla's at 75. It's, it's, it's very reasonable, stable market driven entirely by fundamentals. Those companies are totally going to meet that expectation, right? Somebody asked me about PE ratios. Nah, I can't customize the reactions. Otherwise, they'd be cool. TikTok stock thought? Oh, damn. If we were to ban every single person in chat, would it also hide their reactions? Asking for a friend? Probably not, actually. Girk, did you know that the original Fast and the Furious movie was supposed to be called Race Wars? And it wasn't until Vin Diesel came on board that anyone realized it was problematic. Oh, really? Well, it wouldn't be the stupidest thing I've heard about Hollywood. If someone was synthetic long on a position and wanted to get out of it, would they cut the calls or puts first? Puts? Probably. Well, I mean, you could do both, but for your margin, it's probably best to cut the calls or the puts first. I miss the doodles on the stream. Make a cat lady? Not in the mood. S6 is gonna go straight up until something apocalyptic happens. We'll see. I mean, all the call interest is at 43.75 today, so I'm not surprised we're back at that price. Beginning to wonder if the Fed has any actual intention of slowing inflation. They have so many options, but they're scared to do it. They could do 100 BPS or sell MBS openly. What's stopping them? The banking system will collapse because it's over leveraged. Clinton repealed Glass-Steagall at the end of the 90s, and anytime the Fed makes any kind of decision that actually involves quantitative tightening, all the banks fail. If they don't blow themselves up first. Gherk, the stock market is not an investment vehicle until the company takes multiple generations to earn its share price. Japanese real estate bubble, now in US securities. Fuck. If your time horizon is longer than you will be alive, then yes, they will. Maybe. Hi, friend. Diablo 4 has taken GameStop's place as the most important thing in life. My son has been bumped to third place, you being fourth. I love you, Shill. Nice, man. Don't let it consume all of your personality. Thoughts on BTU future price action? Thinking of selling a CSP for $20 strike. $20 isn't a terrible buy-in. I think over time we're gonna see commodities heat up, especially if we hit a recession. I think BTU will benefit a lot from that. Also, if China's reopening ever gets on track, that'll be very good for them as well. India and China are very, very big importers of coal. So manufacturing capacity is picking up in India right now. Manufacturing capacity is dropping in China, but you know, China's incentivized to get that up and running as soon as possible. And if the demand in both regions is reaches a point where it's high, that'll be very, very beneficial for BTU's stock price. They're also buying back, roughly a third of their market cap in shares. So I think it's a decent price. Hey Greg, it's been 11 months, so I thought I'd say hello. Hi Guitar Stuff. Thank you for this totally reasonable stream driven by cat fundamentals. It feels like Yellen and J-Pow are just trying not to get the blame for a recession. Kind of, yeah. Ball's back in J-Pow's court, so, whatever he does today, the blame will be on him. You think 4350, 4400, June 20 strangle is too wide for today? Probably, I mean, just for today? It's fine if you're just going to sell, and take profit on the spread. If you expect either of those to go in the money, it might be. It might not be. I mean, there's a good chance that we could see one or both of those numbers today. I'm gonna open a strangle a little later. I'm not gonna buy so much theta on it because I don't have any intention of carrying it, but wrong. The banking system is robust and resilient. Well, as long as they don't do anything, it is. Hey Greg, I just found your stream. It's very educational. I have some Fubo 150 cc's for Friday. Are they safe? Probably not. Well, they could be, but probably not. You can roll those out, to like another Friday. Clinton should have stuck to BJ's instead of messing with bank regulations. You could say that about basically every president. It's cute when people think that politicians are the ones that come up with new laws. Well, no, the banks write the law for themselves, and then they pay the politicians to pass it. If you have a stock with a normal cost basis, do you set long-term stops to protect against a hard drop in price? Sometimes I'll carry some amount of like protective puts. If I think there's a risk for a hard drop in price. Or I'll just, sell like covered calls a little bit in the money. And then, if nothing happens over time, I'll just close them out. I want to see if I had my super chat. YouTube changed how it looks. I don't like it. Oh, interesting. Passion, pain, and demon slaying. Well, I'm glad you're enjoying yourself. FYI, only way to get downside to print is to buy a lot of short-term puts, etc. after a 5% loss. Sell all back to the brokers, grab some for the next week out, and watch the brokers want those short-term bags to print hard. Hmm. How many are you buying? Why do you say these things? Do you really think you're buying enough short-term puts that the market maker gives a shit? Gork's about to Gork about shorts getting squeezed out. I think they are all dead already. No, no. There's always shorts. They're never actually dead. They're just waiting. What time frame are you looking at for your upstart 40, 45Cs? July? Yeah. I mean, I have like 220 or 230 covered calls out. So I bought like $340 calls today. Couple different strikes, but well, I guess it's like 150, 40. I'm trying. Hold on, I'm trying to see what I got filled on here. I have 100 and oh no, I have 175 at 40, and 125 at 45. Just in case it pops the top. Otherwise, I'll close them out and then sell more covered calls, which should offset any loss. It's just that like if the $40 CCs get blown out and they start closing, it could rip. And it's getting to the levels where like the longer term entrenched shorts are starting to be at risk. So I want to make sure I have a little bit of protection. GME back to normal. At least I sold some covered calls yesterday. Not many, but a few. Brokers don't want to pay. I'm saying we're going up. You do know that if we go up, they still have to pay, right? Who the fuck do you think is selling the calls? It, you didn't tell me about any of those. You said something about GME, then it tanked on earnings, and now you're saying you were right after you bought a bunch of calls going into earnings. You said literally nothing about Cat and Upstart. Your hindsight fund is performance is amazing. I was out of my calls pretty early yesterday, but I was pretty well over my price target. Since VIX is already so low at this range, would the Ivy crash be obvious this time after the meeting, or would it stay relatively the same? I mean, Ivy doesn't generally crush right away. Usually by the next day, it starts to come down. I would say that Ivy is pretty low right now, given that we're going into the meeting, which means that the confidence in a pause is extremely high. Do you have a low price target for GME, and do you think it'll keep going down? I don't know. I'd probably see it around 20 or under 20 in the next couple months. The bottom there is still around like 16, 15, 16. But I don't know if we'll hit that without some serious shorting coming in. McKinsey published a big 68-page report on AI and economic financial implications today across multiple industries, free to download. Cool. So many memories. Cue montage of Gherk on Houston stream. Swipe into course trolling. Cut to scene where Gherk is banned from SS. Fade into Bobby Cry Guys. Sunburst transition into tips touching. Thank you so much, Toilet Wine. Oh. The market has gone up 5% since the beginning of the month. There's no way JPOW wants this nonsense to continue. How on earth would he pause? At least he'd have to do QT. Well, we'll find out. I'd prefer QT to another rate increase. I don't think the rate increases are really helping anything. When was the last time you were optimistic for GME? Hmm. Yeah, I mean, I bought calls at like March earnings, like Q4 earnings. It was pretty optimistic going into January. Can you make a school of stock video on how to buy T-bills? Just go to treasurydirect.com. Some brokers offer them as well. Grated pecorino and eggs is fucking amazing. Yeah, it is. A few weeks ago, you watched a large call purchase happen, and you said, okay, let's see what you got, GME Bull, and you made a quick 100%. That was fun. Yeah. That wasn't really like optimism, though. That was just a big call position coming in, and we were like, I think at the time we were like right at delta neutral. I'm planning to drop a couple hundred on 0DTE puts right before the meeting to catch a massive downside with only a couple hours left in the day. Bad idea. I mean, only puts? That's the game plan? You're just gonna buy puts? Go for it, Thunder 86. You can yeah, go, if you want to vent, go nuts. Morning shills, who wants to be abused with fake internet power? Well, there you go. Gordon, immediately. Did the green screen eat Gherk again? No? I'm doing my first JPOW straddle today. I'm so bricked up. Nice. Yeah, I'm just sitting on mine. Although I kind of want to get a strangle also. I haven't decided on that yet. Okay, why is that not fucking working? Hold on. Are there any of these that aren't complete dog shit? Volume. Ooh. Hmm. That's actually kind of impressive. Interesting. So up here a little bit still. Or is this breaking down? Oh, I like this. Dork, I found goodies. Hmm. That's actually pretty impressive. Okay. Yeah. Yeah. Look. Hold on. You're gonna like this. Ah, son of a bitch. No. Check this out. Um, this is, yeah, this is fun. Okay. Could you get your play on the Fed meeting today? Expecting big downs? I'm straddled, and in a little bit, I'm going to be strangled. At my current success rate trading, I should be able to retire in 10 years after my death. That's not bad. Good morning, Kirk. Happy 11 months in the jar. Also, kind of surprised no one here has noted all major US stock exchanges will be closed on June 19th, 2023, in observance of Juneteenth National Independence Day. Thank you so much, Pickle Brigade bot. Don't forget, markets are closed on Monday. To be honest, I do not like today's stream card. Why? Is it the production quality? I know it's shitty. My kid just waved to you on the screen and said hola. Hola. Are we skipping OPEX because holiday? Uh, it'll change settlement. I don't want to be that guy, but would that make it Black Monday if we crash? Well, you've just become that guy. And then, no, it'd be Tuesday. Also, I'm not sure that the choice to use, like, the term black and Black Monday or Black Friday has anything to do with African American people. I think it has to do with like black cat superstitions, or at least I hope. I'm holding some dead 4270p for Friday, wondering if it wouldn't be worth averaging them way down this morning. I'm just throwing away money or big smart. Well, all the sold puts are mostly at 250. A few at 4300. So, I mean, you really need JPOW to fuck shit up today for your 4270s to print. How dare you insult Gork's art? What nerve? I mean, I know I'm not good at making stream cards. That's why there's an entire channel dedicated to making me stream cards. Thanks, P Shorts. See, art's subjective. It's okay for you to not like it. I liked it. Black Friday is because that's when retailers go in the black on the year. Huh. Okay. That makes sense. Good morning, Gurk. Scalped at SPX 4380C this morning for a 50% gain. Nice. Thanks to the morning gamma charts. How's OI looking now? Ooh, I could look. Probably relatively unchanged because the Fed meeting's coming up, but I'll take a peek. Looks about the same. Yeah. So all the call interest at 43.75, then it falls off pretty hard at 43.80, and kind of middling interest between 43.75 and 4400, which is the next highest level. I do think a significant number of the 4400 calls are sold. 4360 through 70 Uh, stable. Puts are building up around 43.50 and under. So yeah, unless we drop below 43.50, we're probably gonna stay pretty locked up here, right around 43.75. There's not a lot of interest on either side of it, so I'll let you know if anything changes. Thanks, Jen Jen. Historically, Black Friday was the first day in a retailer's years that their books were in the black as opposed to in the red, since holiday season when they made all their money. Black Monday wouldn't be a cat reference, but Black Swan. Yeah, but the Black Swan thing also, comes from like black cat superstition, right? Like the idea that black animals are somehow evil or sent from Satan. I would have liked it better if thumb was pointing down. Which, now that I think about it, it's probably racist. But we don't know which direction the thumb's gonna point, Cobra. I petitioned for a hashtag mommy milkers channel. It's not happening. Ever. If China really, you gotta spell it like that, dump their treasuries, those would have to be sold in dollars, correct? Wouldn't that cause Dixie to squart down? Hey, thoughts on GME moving forward? First of all, we probably wouldn't satisfy them, right? You're talking about like a major international incident. I mean, that's when you win, right? As a superpower, when your direct competition is like, "Hey, pay me that money you owe me. I'm kind of fucked right now," and you go, "Nah, nah, bro." I like your stream card. I put a gold star on my monitor, so it's on you for your great work. Thanks, Venseg. If you were to strangle the announcement with Spy, would next Friday's expiration be far enough out? I'm thinking 442, 435p. I guess if you're gonna get it that wide, sure. My strangle is gonna be like $20 from wherever spot is, and then 0 DTE. I already have a straddle with Theta, so what's up with Upstart? It's getting pumped by Nasdaq and bots really, really fucking hard. It's not that there's actually a lot of interest on Upstart itself, but it keeps squeezing out the sold calls, and then it's got some middling call interest coming in, but not a lot. Mostly just tailwinds from the AI ETF, which is its only real source of synthetic liquidity. So the shorts have piled in, but they're getting fucked. The video went up a lot yesterday. Thoughts on Jimmy moving forward across the next few weeks? Reckon we'll pull back a bit after all these ups or continue this strange melt up? It's not strange. The markets are going up. GME's part of the market. So even though interest on GME is low, its beta is still pretty positive. some liquidity came back after earnings, so it's a little less positive now, but turns out they're not as rare as they thought. Are these levels, would a large correction ever take us down to 3,800, 3,900 levels? Yeah, a big correction would. I always close out of my straddles wrong. I should cut the winning leg when it peaks and let the losing leg hang out for a while. I mean, you don't have to. You can just cut them both. But recently it's been beneficial to leave the losing leg open or average it down or hedge it. I mean, initially, like right at market open, you can make some determination and turn the losing leg into a spread, right? At least a short dated one. So you can sell, like for instance, you enter a straddle at like 43.50, right? And the next morning the market opens at 43.65. You can immediately sell, 43.50 puts, or even higher, right? You could create a wider, you could sell your 43.50 puts and follow this with a stop, right? Or you can sell a spread against your puts, right? So you could sell like 43.60s or 43.55s. But like, if these are 5.7 DTE and these are 1, right? And then as this keeps moving up, you can close this out. And then you can use the additional credit to average these down if you want to. If the end of day closes at like, say like 43.70, you could use this as a strangle, right? Because the puts you sold are going to fall off, right? So you've offset the theta decay and some of the losses from the short leg. Or the put leg. There's a lot of things you can do with it. I would argue the market melting up is strange. Fair. How does China reopen with 20% unemployment? That seems like a big hole to get out of anytime soon. Yeah, it's a bit of a problem. Watched Patton Oswalt on Celebrity Jeopardy last night. I don't know how he can be so smug up there, knowing that he murdered Left Eye Lopez. That's not how it went down. I clicked on a weird cube pillow ad that came up. I got you. Nice. Thanks, Stefan. This whole pause narrative with massive zero DTE pump right up today feels like the biggest bull trap of all time. Yeah, but isn't it awfully obvious if it is? There's a ton of options in the money going into OPEX. That could be huge unless they tank it over the next few days. I mean, it could be hugely detrimental, right? If those all close and the market maker starts shedding all that hedge. I mean, right now, like the post OPEX period for SPX looks like the market's going to come down regardless because so much positive delta is expiring, right? And the market maker is going to dump the massive hedge they're carrying. Caterpillar just declared an 8% quarterly dividend increase, raising its dividend to $1.30 a share, up from $1.20. Nice. How exciting. They got a lot of cash, so. Good morning, Ending. Sorry if I missed this. Vic's getting killed again, but you're still waiting until after JPow's speech to close your VIX calls, right? Yeah. I mean, I closed a bunch of them when we hit 15. Like I said, I had a price target, but I do still have some runners. I'm trying to get a bear put spread on GME at 46 at 26.20 for July 21, and I can't seem to get a fill. Is 40 cents not a reasonable price? I don't know. Look at the fucking chain. You're trying to sell July 21 what? 26.25? Oh, bear put spread. Why? No, no. Why do you want to sell a bear put spread for GME? I'm just curious. Also, these are both trading significantly higher than 40 cents. But what's the thought process behind that? I'm just thinking of Skip is 95% likely and priced in. There doesn't seem to be much room to go up. If most of the move happened in the last 2 weeks, it doesn't feel like much upside risk. That's fair. But the zero DTEs can just come in and pump it up again, right? So I sold some yesterday too, crypto. Does SLD actually do anything these days? I mean, yeah, supplemental liquidity is deposited. The the event that you're describing always happens. JPO will pause with dovish guidance because he cares more about keeping his balls from being shut in the revolving door more than the economy. Also, if that happens, we're breaking 4,400 today. Mark my words. Uh, I'll forget. I forgot the cheat sheet. Cheat sheet? Is it red tie hawkish or blue tie hawkish? I think he avoids red and green ties on purpose. Strangled at 4360p, 4475 call. Jesus Christ. So you're right at the money with the put and way the fuck out of the money with the call? I think your call's terribly positioned. I think he's only got one tie. Yeah, it's like Violet, right? JPEL wanted he only makes $180,000 a year. If JPEL wanted a crash correction, this would be the perfect scenario. Everybody expects a pause, and if he just hikes a little, he gets his correction. He'd have to hike more than a little to get a correction. He doesn't need to hike at all. He can just bump up quantitative tightening. Is SQQQ ever going to go up again? Well, if at NASDAQ 100 goes down. How bearish should it be if he walked out in a sweatshirt with messed up hair and his face covered in lipstick kisses? Actually, that might be bullish. I'm trying to buy the put spread. It's like a depth. What? This is a debit spread? You haven't helped with the confusion at all. What does he do today to cause a recession? Tighten quantitatively. Jan 17, 2025. CC bid for GME is at 650. If I sell them and the strike hits, will I get assigned this week? Probably not. If you sell a Jan 17, 2025, you probably won't be assigned till December of 2024 at a minimum. Regardless of the outcome today, we'll find out what JPOW's general stance actually is. True, yeah. Nothing like tying capital up for 19 months. Why the fuck would someone buy that contract off of you and exercise it right away after they paid for all that theta? Jewelry affairs. Why would he take the blame to tank the market? I don't get it. Someone has to be the bad guy. I should not have let Jesus take the wheel. Hey, Rusty. It's good to see he got you home safe, though. Is that a song about drunk driving? Huh. I feel like the market is going to crash tomorrow in perpetuity. Okay. Good morning, you good-looking son of a bitch. Looking to lower my cost basis on Fubo a little bit. You think going under 2 is reasonable to wait for? Sure, yeah. I don't think they don't have earnings coming up anytime soon, right? Yeah, you got a while. I don't think under 2 is unreasonable. It's been doing well though. It's not going so crazy today. I might sell some more $2 covered calls. Or maybe 250s. Since we're on the upside of 225. Ooh. If you buy a stock, immediately sell CCs to get assigned as soon as possible and pocket at least part of the premium. Is that a viable strategy, and does it have a name? Yeah, it's called a buy right. All I need is a test of 4,300, and I can get out of these 4270s and break even. You fucked us all, didn't you, OG Rules? I feel like the market is going to rip in perpetuity. I sold some 721 250s about 30 minutes ago. Oh, nice. For a small account, SQQQ is pretty attractive here. No. Uh, why not just QQQ? I didn't check the Lily rant yet. What is it? Oh, look, I'm Lily. I'm a sack of horseshit pretending I'm one of the big boys. The only downs I have are the bears trying to buy puts on my stock. Did someone do an itty bitty TA analysis on me thinking I would have a pullback? Nope. The only pullback happening to me is when I grab the back of these bears' heads and pull them back as I analyze their put holes. Oh no, I'm supposed to trade sideways for long periods of time, then make moves. Get fucked, nerd. That's just me stroking my green cock before I drop another drug announcement. Lily 500, fuck your puts. Nice. I'm gonna buy some more puts on it, actually. That's got me feeling real bearish. I wasn't gonna throw any more money at it, but you've convinced me. Because small account to manage, I don't know. I found I trade better in the 3 to 5K sized account. So I get gains, then withdraw to that. Interesting. Do you have a are you having difficulty with scaling? You should solve that. Did I just listen to someone's stock roleplay? I think so. The worst part is his Lily position was up. There was a point at which he was making money, and I don't think he sold. Is that correct, Thunder? You were your puts were green at one point. I only hit break even for 30 minutes. Actually never up. I know I had some like 425s and 420s that were up quite a bit at one point, but I didn't cut enough of them. I only cut like 10 contracts out of like 20. Not no, 25 contracts. So less than half. Sorry to hear that. Sam Tarley did solve scaling. I just bought a call for GME at market and it filled at the bid. If this is happening to other people, the data may look like calls being sold but are being bought. It's the skew that makes it look like calls are being sold. Not the bid ask. The bid ask is not does not determine if calls are sold or bought. Also, who the fuck buys an options contract at market? Don't do that. FOMC releases results at 2 p.m. and Powell speaks at 2:30. That's correct. I only buy at market. I know you do, Popcorn. I needed like 420 and we hit 422 for a tiny bit. My main issue was I was over leveraged way too much. Rebuilding a different port for 25k with a max 10% position per position. Smart. Yeah, don't get over leveraged in any one position ever. Not everything's a winner. Can you write some things on the screen while talking about what can happen at 2? Sure. Powell can fuck everybody, or he can be a little bitch. Those are the two outcomes. And you draw that? It's not appropriate. You mean he can fuck everyone, or he can fuck us? I have straddles and strangles. I'm unfuckable today. Why would you say that? It's true. Well, I guess we could trade sideways. Then I get fucked. But only sideways. I think I'm okay with sideways. Well, I can sell. I can sell against the straddle and strangle, right? Just turn them into condors. I did an inverse Jade Lizard. You don't even know what the fuck that is. Duct taping a green lizard to your office ceiling is not an option strategy, Popcorn Trader. He's wearing a hat. Of course he is. Is Fubo running because the market's rising, or is something else going on with it? There's a little bit of short covering, but yeah, mostly because the market's rising. People pulling back sold calls. Thanks, Jade. Hey, Greg, I just want to ask something that I think hasn't been addressed in some time due to all of the market mania distracting everybody. So my question to you is this: Wind down. Uh, we'll see. I hope today. I hope for the next 5 days, nothing but. But I've done this for long enough to know that JPL will do something bearish. The market will rip to 44.20. We'll sit there until Thursday. Friday? No, we'll sit there till Friday. Futures will dip a little bit overnight. And then the market will open down 5% Monday morning. Because that's how things go. I'm sorry, yeah, Tuesday. Tuesday morning. Are futures closed on Monday? Yeah, right? No, I don't mean that, Celtic. Take it back. I mean, that's kind of what happened with the COVID crash, is that, like, we just opened down a lot, right? And then everyone was like, oh, fuck, I only have calls. Because we were just ripping right up until that point. SPY straddled 438, 435, June 16. Can you talk about strategies for placing stops? Yeah, I mean, I think your put becomes unviable on a move above 4040, and the same is true for your call below 4360, or 436. Although I don't know the structure on SPY, so I'm using the relative levels on SPX. But you would probably want to consider placing stops at either of those two confirmation points. So for SPX, that would be a break above 4,400 or a break below 360, and then you're gonna put a stop on your losing leg. Confirm the breakdown or break up, and then continue to adjust the stop on your winning position afterwards. Nvidia made a new high. Cool. Maybe I should sell some more spreads on it. Where's Gamma Max? Mm, too hard to determine still. Ah. Hmm. Interesting. Gamma started to fall off into today. So 420. What's Nvidia trading at right now? 418. It's so risky. It's the same as its previous high, 418.87. Maybe 425? 430? Gamma Max is still 450? Oh, okay. I don't want to open bear spreads so far under it. I've been avoiding them. But this looks very tempting. Oh, okay. Yeah, I see that. I was looking at the hourly chart and it just shows 418. Can I do 420, 425? $5 risk, $2 credit? 425, 430. 25, 30. 25, 35. Actually, 430, 450. 430, 450. 425, 450. 425, 450. $4 credit. And if I have to buy a call, $25 spread. 7 delta. Hey Greg, long time listener, first time caller. I need advice. What do I do if internet people are orchestrating a vast conspiracy against me to include calling my doctor with an AI rendering of my voice? Bi-weekly meltdowns? What? The fuck are you talking about? Are you okay, man? It was me. NW said the pickle jar was doing that last week. Calling his doctor? You guys all need to lay off the fucking drugs. Or on them. In the money SPX 4380 Cs aren't taking profits yet. What's the top of our range pre-meeting? There's still not a lot of interest picking up higher, so yeah, 4380 still kind of looks, well, like a little bit of a resistance. I think both sides of 4375 are straddled, but there are some puts at 4400 as well. It wasn't true. I intentionally lied. Oh. Are you trying to root out the bots? Everyone's a bot. I'm a bot. Sup, G-Man? Thanks for being a daily info market god to us poors. Thanks, Proving Crown. Fun fact, doctors don't validate you by your voice. That's true. Well, not yet. I got the expected response. Okay. I don't... I kind of missed this whole thing, so I don't really know what the fuck anyone's talking about. The Tiananmen Square protest, known in Chinese as the June 4th incident, were student-led demonstrations held in Tiananmen Square. Ah, you're trying to get me shadow banned on YouTube again, Grant Jackson? That's not cool. Winnie the Pooh just wanted some honey, bro. Alright. I've already moved on because I don't know what it was in the first place. Basically, NW accused JTA of recording his voice and trying to call his doctor. In the end, this all just led to a conversation regarding mental health. The internet is pretty wild. Okay. What does this have to do with stocks? Thoughts on 17 DTE 438C hedged with 10 DTE 434P to hold through early next week. Okay. That doesn't seem bad. You're a little your bias is a little bullish. But if that's what you intended, then you've done it correctly. Generally speaking, events like this, I try not to bias the positions. Although I have a shitload of puts right now, so it's kind of impossible for me to go truly neutral. I'm pretty sure Natty is still in the pickle jar and still holding Fubo. Probably underwater on covered calls now. He didn't accuse me. Okay. Do you think it likely that the market nets flat on the day from here? It seems like it's 43.50 or 44.20 kind of day at the flattest. Oh, I hope not. I mean, it could, right? Everything's priced in, market's efficient, but I hate that idea. The higher this goes, scare you? Not really. It's annoying managing the put positions as it rises. But it is what it is. I mean, I know how not to lose my ass when the market moves against me, but it still hurts. Patience is tough. Paying for it's even tougher. I think Natty left the Discord. I could have sworn I saw them in the Fubo channel like a week ago. I think it's a different name, different screen name, without all the baggage of being Natty attached to it. Puts are 30% more money than calls at the money on the SPY. And yet, that doesn't seem to be being reflected in the VIX. If you buy longer dated expirations, the cost won't be so high. If you're a bot, you need updating. Are you excited for the 296 tomorrow? Wait, what? What are you talking about? Juice Caboose has 296 Billy issuing tomorrow. Really? Did they add another one? I only see 65 and 55. Oh, the 20 year? How much are they doing on the 20 year? It doesn't have an offering amount listed. Oh, wait, no. The 20 year is announced tomorrow. It's not. The auction isn't tomorrow. Yeah, I only see 65 and 55. Oh, issuance. Are some SPX calls closing here? Not really. Some out of the money ones and some in the money ones taking profits, but nothing big. Somebody opened some 44.25s. $43.90 and 4400 are getting a little stronger, but that also has to do with our moneyness. I don't really know if a lot more volume has come in on those strikes. The issuance from the previous auction. Oh, the settlement? The settlement of the previous auction? It takes time for the realization of contracting liquidity to hit the indexes usually. It comes and goes like the wind. Levi is up to 15.17. My leaps are gonna print hard. Nice. Long on jeans. Didn't someone post to Discord that on RRP is dropping in line with the TGA offerings? It wasn't prior, or at least going into this week, it hadn't. I can take a look at it today. On RRP did drop yesterday. Yeah, on RRP last week was pretty flat over the course of the week, but last night on RRP fell off. Oh, like 53 billion. I mean, that's not in line with the T-bills, but I'm sure like there's some money that'll go into them. If JPAD does another 25 here, what happens? More money goes into on RP, yields go up, dollar goes up. DDS clawing its way up. Yeah, it's still running. How long and how low can this DVN dip go last? Probably till oil moves up. Oil's been pretty stagnant between like 68 and 72 a barrel. It's a very specific price range for GME. They got a little bit of liquidity on GME this morning. We started to see some contraction in its liquidity. I don't know if that's persisted. Yeah, it really hasn't persisted. The tips are kind of flattening out now, so pulling back a little bit, but not as much as they had pulled back this morning. So they're still just kind of shuffling liquidity around. Should I wait on Upstart? FOMO's killing me. I don't know. I picked up some calls this morning. Just in case there's any capitulation. I still haven't sold all my CCs, but right now where it's at, if $40 covered calls capitulate, it could be a problem. And Nvidia is still running pretty hot, right? So there's a lot of pressure on bots. We didn't melt up for 6 months. The market almost crashed in March. You're being hyperbolic. Just because people didn't sell their puts when they were up, it's not my fault. So if it melts up for another 4, could. Prediction, market stays near where it's at after volatility, during and after FOMC. Then SCOTUS releases student loan opinion tomorrow or Friday. Then we dumped for SLD, but blamed on SCOTUS. Okay, interesting. Global cocoa shortage sends prices soaring as consumers should brace for chocolateflation. Gurk, start hoarding the chocolate bars. Okay. UNH issued 1.88 supplemental dividend and gap down hard today, 52-week low. I'm thinking about getting some July calls. Thoughts? Might be a little soon. Hold on. Let me look at it. Hmm. Yeah, I wouldn't. I don't think they dropped on. I don't think they just dropped on the dividend. Their forecasts for the year are not positive. They noted that it would see its medical cost ratio in the second quarter of 2023 come in near or above its outlook for the full year. Also, insurance companies carry duration risk. Yeah, I wouldn't be so quick to load up on calls. It may bounce, right? This may be a little bit oversold, but issuing a dividend and missing their projections on earnings for the year is gonna be bad. Like it could continue to sell off. This thing's just gonna get more and more top heavy, isn't it? I mean, maybe. We're really gonna enter the FOMC meeting at a high. I kind of want to cut my calls, but I can't. A correction at this point feels like it would have to send us back to the Stone Age. It would be pretty dramatic. It feels like the entire recovery for the next 10 years is being priced in. Yep. How could Juneteenth, Monday, affect the T plus 2 from quad witching? Is it as simple as T plus 2 being through Thursday morning bell? Or are there esoteric FINRA rules that can mess with it? There's FINRA rules that can mess with it. Settlement can be deferred due to the holiday falling during the settlement period. If you want to start accumulating long-term SPY puts, do you think Jan 24s at 420 strike sufficient theta? They're fairly cheap. It's a decent amount of theta. I mean, it definitely gives you time to confirm and reposition if you need to. What the fuck is happening? Normally we're range bound in $10 to $12 range. This is silly. 4,500 has to be taken seriously. I'm not sure 4,400 has to be taken seriously just yet. I mean, there's calls. There's a lot of zero DTE calls. We moved through like the resistance at 4,380, so there's a bunch of zero DTE calls at 4,400. Is there a particular options chain tell that can happen in determining a bull or bear market? Um, yeah, I mean, historically, you'll see uh, call interest accumulate on farther dated strikes out of the money in more significant quantities, right? Like leaps. Um, you'll see positive earnings reports year over year, which we haven't. The short put side of the interest would generally be further out of the money and longer dated as well. If there was a lot of confidence in this, yeah, we'd be seeing more long dated positioning come in. And we aren't really, right? Most of the calls that are on the chain right now expire between 616 and 721, and that's seriously front loaded. We would start to see the further out contracts and futures pick up more. I mean, right now, like the ES contracts out in like December of 27 are trading at 4,800, which is below our Jan 21 highs, right? Or like right at our Jan 21 highs. Yeah, it's doing that thing where VIX and the market go up at the same time. No, there's not a lot more calls here. The volume's still pretty flat from this morning. There's some puts at 4,400 though. So resistance there. Bro, this might be hopium, but to put it on the 20D and tell me there isn't a high chance this is the top. I mean, it's just going to depend on what Powell does, right? By pushing it up here, they're protecting their short puts into the decision. They might be pulling back their short puts right now. Right? VIX is moving up with the market. The pause must be priced in by now. The full recovery of the US's economy for the next 5 years is priced in right now. What range do you like to buy shares in BTU? Ideally under 20, but I've bought at 20 before. Upstart not moving up with the market. Is NASDAQ really moving right now, though? NQ's pumping a little bit. Upstart will catch up if it keeps up. No, currently the expectation is for a pause. Isn't it kind of weird that we've been trending up? I mean, not really. The call side's stacked. The only resistance that was present was at 43.80, and we got hung up on it for a minute, but then we broke up. This philosophy about not seeing longer dated calls in the chain is antiquated and old think, I believe. Sure, that may have been true in the past. You mean in 2021? But we're in a different game now with the zero DTE manipulation. This is a new strategy. No, it's not. It still creates tail risk. It's just more leverage loaded onto the front end. It doesn't change the mechanics of anything. What are your thoughts on Upstart if we pause? That would be an immediate rocket with the shorts closing their positions, right? They might, yeah. If the market doesn't dump. A pause by the Fed with nothing else, right? They just pause, no other changes, or skip, is gonna pull some amount of liquidity into bonds. Because if they think that the Fed isn't going to proceed with more rate hikes, that means that we're at the top for yields. It's not it's not like bullish, right? It's just a pause. Based on the proximity of my lizard to the ceiling fan, he also has some tail risk. It's a new strategy. Leverage has never been abused in the US markets, like ever, man. Yeah, totally. Crypto never ripped because it offered 100 to 1 leverage. That couldn't be why Bitcoin hit $65,000, right? That was just because concerned citizens were protecting the future value of their money, right? With a stable decentralized asset, right? It wasn't because hedge funds bought the shit out of it and leveraged it, right? Crypto's the future. It's not the past. Does anyone know of a good Chinese EV ETF? Tesla? The ticker's TSLA. Chinese car sales are down 60% year over year and declining. They have 20% unemployment and they represent a significant amount of Tesla's revenue. But it's cool. In 5 years, Ford's gonna change the adapter in their cars. Maybe. If they feel like it in 5 years. Cardano fixes this. Popcorn trader, I'm going to tell you something that you're already well aware of, but for the benefit of other people. Don't get in the ring if you don't expect to get punched in the face. I literally have no idea what this is about. I know. I do the punching. IWM 192C, 0 DTE volume, way up. I've never lost on a stock pick ever. Huh. Okay. Beyond Neo, Li Auto, Xpeng, starting sales in Europe. I wanted to try to get some exposure. That'll be really good for them. You can just get those. They're all pretty cheap because they suck. I've just been early, late, or wrong, or both. It's, sometimes you've actually been right, but you've bought calls that are so far out of the money that they never had a chance to print. Did you close your overnight straddle? No. Currently, my overnight straddle is very much in the money. I have a strangle also. I might open one more strangle as well. But yeah, generally I hold the straddle through the FOMC meeting. Are my 510Cs safe? Well, they don't exist, so sure. I learned in Hong Kong a couple of years ago, they had an incentive where there was like no tax on Teslas. So it's actually cheaper to buy than gas cars. So everyone went out and bought one. Well, now they already own one. Those Bobby ADCs spoiled me. I kept the put side open and averaged down, hoping JPAL will make Chad moves. Have you looked at or traded XSP before? Yeah. How is it different than SPY? It tracks SPX and it's got a tax treatment. Is it worth it to trade it over SPY? It can have liquidity issues on the spreads at certain strikes. It can be for swing trades. It can be much better than SPY, but trading it intraday, not always. Once Teslas all fall apart due to their terrible build quality, they will have to buy new ones. It's genius. It's like the iPhone of cars. Could you discuss the situation that made Rev 35C such a great opportunity? I feel like I understand the Greeks much better now than when Rev was a thing. Yeah, so Revlon had almost no float, right? The entire float was like 4 million shares. And implied volatility on Revlon was at the time spiking between like 190% and 450%. And those contracts had a pretty decent amount of delta and a great deal of vega for their price. And so anytime Revlon's IV spiked, those contracts would go up like 50 to 250%. So the idea behind buying them was, you know, you could make a lot of money off of the volatility spikes if you bought them at a volatility low, right? And the volatility spikes, you know, basically continued up until the delisting of the stock. Had the stock not delisted, volatility would have shot through the roof. It didn't really meet any of the qualifications for delisting. So there was a non-zero chance that it would remain listed, and if it had, um, then shorts, you know, at the time would have had to have covered on the open exchange, right? And you know, you would have gotten one last big massive volatility spike. Revlon was actually really profitable up until the point where it got delisted. The problem was is that everyone started treating it like it was some sort of guaranteed squeeze instead of what it was, which was highly volatile with a small potential for squeezing. Want to hear something painful? I cut some losses on some upstart bags I'd been holding about a month ago. Jan 50C. Ah, that sucks. Thank you so much, Brett, Wesley Sexton, and Magnanimous. Welcome to Cornishon. Rev made some people really salty. Yeah, it did. I warned them as much as I could. Adopted by the Dans. Thank you so much. Balani, give Adopted a shout out. And also welcome to Cornishon. Not as salty as Bobby. Well, everyone thought I was like trying to fucking help the short hedge funds or something when I sold my Bobby and told everyone they were going to lose all their fucking money if they didn't sell. Then they lost all their money, but it was my fault, not Cohen's or their own, for being idiots. They continued to hang on meaningless DD that pumped them full of hopium for the next 6 months until the company went out of business. I'll say it. I said it then and I'll say it again. If the CFO of the company you're invested in flings themselves out of a building, get out. Let the dust settle at least, right? Do you think Jimmy is going to do a stock buyback? No. That would be fucking stupid. Some people hear you say something is possible and then assume that means it will happen. I made money on Rev because I knew a squeeze was possible, but not even close to guaranteed. I made a bunch of money on Revlon too, and then I threw it all away on Revlon. We made money on Bobby. We got several opportunities to break even. Sometimes paper handing is good. Yeah, it's usually good. Go cry about it, Rusty. Are the market's always this dramatic and volatile? It seems like getting into investing in the past few years has been a crash course. Yeah, they're usually not nearly this interesting. Although after 3 years, I would say that this is becoming the new normal. If Jimmy is probably going to issue, if anything, Jimmy is probably going to issue more shares. I don't think so. They'd have to do something to produce additional revenue before that would be justified with the $1 billion they're currently not using on anything. Are you timing everyone out, Fluffy? Brett, thank you so much. Guys, welcome to Cornichon. Give Brett a shout out. And adopted by Dan's. I appreciate it, guys. And I love anal logies. By the way, after your 100th lesson on straddles and strangles, I've been doing them regularly, and I've been making money for 3 days straight. Thanks for constantly telling me, how to be better. Nice, dude. Congratulations. Alright, fair enough. I just saw them grayed out, so I assumed they'd gotten timed out. I hadn't caught up in chat yet. I bought this little box off Amazon that moves my mouse around to make it look like I'm busy at work, and it's really changed my life. Do you plan on averaging down your July month expiry puts? Or are you gonna move them to higher strikes? I mean, I've averaged down some of the Julys. I've bought some September Vega plays as well since Friday, or well, Friday last week. But no, I'll probably just close them. How do I accept gifting? You have to turn on the little thing and click accept gifting. But if you have like a commercial account or whatever, then you can't. What's the end game here, man? It seems like causing a steep correction would allow us to return to some sense of normalcy. Much quicker than walking on eggshells, pretending everything's okay. No one's gonna lose money, right? Especially nobody with money. It's all about preservation. So if they have the ability, they will keep the market as high as they can until they can ensure that they take on no risk in the event of a crash, right? Or a steep correction. And if they have the money and the means to guarantee that, they will take advantage of that. The market went up 18% going into the COVID crash. from its low. It took about roughly 4 months. Now there's even more money in the system. There's even more equity ownership, right? And if they find buyers, if people get really bullish and everyone accepts that everything's okay, they can stabilize these levels for some time. So far, that hasn't happened, but we're definitely on the cusp of it moving one way or another. It's a motor with a wheel. The mouse sits on top. There isn't an app. They only figure it out if they physically watch my screen and get suspicious. Is there any validity to the often shared graphic of market sentiment that shows a peak, rebound into new normal, then dump? Yeah. What's for some time? Weeks, months, more? I mean, that depends on data, right? If we move into a recession within a month, obviously, that's gonna make it difficult to continue to have a bull case, right? But politicians don't want a recession. The Fed doesn't want they don't want an official recession, right? The powers that be do not benefit from it. What would be the benefits of doing a straddle slightly above the money? Would that be a slightly more bearish skew, right? Yeah. Rate of inflation down, cost of inflation plateaued. It's got to be a pause. PCE is up. PCE and the CPI index are up. PPI is deflating. Right, it's moving very close to deflationary. Unemployment's moving up now. Can you explain the short treasury's impact to the market? Jim Bianco posted a chart calling it the largest short in history. It makes them unattractive from a speculation standpoint. So it reduces liquidity in the treasury market, or incoming liquidity into the treasury market, even though rates are high. We don't see a flight to bonds, not yet. What's the name of that device that moves the mouse for you? Asking for a friend. GDP will be interesting in the next few quarters. Yep. Yep. This quarter should theoretically be the highest, and it doesn't look that hot. Still in the yen Nikkei position? Yeah, until like 2025. Slow breakdown back to 43.80. Maybe back to like 43.75. We finna blast off. Gamma Max came down today, so people sold calls yesterday. I don't think everyone's as bullish as you might think. It's called a jiggler? A mouse jiggler? Why? So it just jiggles your mouse? Who benefits from shorting of treasuries? Well, I think it's a hedge against floating rate interest risk taken on by large banks during the massive liquidity flows of mid 2020 to through early 2021, as they took on swap risk on those hold to maturity securities. So those interest rate swaps benefit from keeping treasury prices low, right? It's a spinning disc to make the optical mouse think it's moving. Huh. Whatever keeps you from having to do more work, man. I'm all about it. Congratulations. Is there any advantage to strangle with a negative width where both the call and put are in the money at the time of purchase? No, not really. Although that situation can happen when entering a straddle or a strangle. Well, it'd be probably more likely be a straddle. Um, they don't really benefit greatly from that positioning, right? It's called a guts. But their profitability isn't much different. They're profitable usually outside of the range of the position. So like as long as prices move, which isn't too much different than a straddle. They're more expensive. Whose job performance is measured by mouse jiggles? Work from home in probably major corporations where individual employee output isn't closely monitored. Do you think Jimmy announces a new CEO tomorrow or too soon? I mean, maybe, but I can't think of anybody who'd be jumping at the opportunity. Did you ever enter the target position? I did. I also closed it. It was just I just did it for like a week. It expired out of the money. How tight will you set stops after the first move at 2? These things seem to reverse direction quickly. Well, I have the longer dated straddle, which I can kind of hold through the volatility, and then I have a couple shorter dated strangles. So those will just have stops on them right away. I can't wait to see J-Pow today. Have him whisper sweet nothings into my ear. I think J-Pow shifts focus to bonds today. I think they need to do some quantitative tightening because the Treasury is going to start depositing money, and they haven't trimmed their balance sheet basically at all. And handy? Long live SLGG purchase rumor. Why would you want GME to buy another money sink that doesn't produce any revenues? Facebook's chief of strategy left at the beginning of the year. Shelly something? You don't think she'd be interested in the role? No, absolutely fucking not. Why would Facebook's chief of strategy move to be the CEO of a brick and mortar retailer? Those aren't even the same sector. First of all, with her comp and the current price of Facebook, she can just retire. For the vibes. I mean, I wonder where people get these ideas. You know why like some big name CEO didn't take the helm at GME 2 years ago? And they ended up with fucking some nobody from Australia's Amazon C-suite? Buying Funko would actually not be a terrible move on their part, but I don't think RC has much forward vision or insight at this point. It wouldn't be terrible. I mean, their margins are good if they can start to turn a little bit more profitability. Although they've taken on a lot of debt. Ugh. Yeah, I haven't looked at their balance sheet for a couple of quarters. Gross. Yeah, I don't know if that would be a good buyout. Probably available, but it doesn't seem like a great purchase. At least not for GME. It's not like they have like good supply chain integration, right? Everything they do is just outsourced. Are we going to be streaming the annual shareholder meeting? Yeah, sure. It's tomorrow. I don't, bro. It's sarcasm. Oh, sorry. I didn't read the username attached to the comment. It still confuses me why people think that SLGG would have been a good purchase in the first place, though. My old manager at a restaurant is free. Maybe they'll tap them. Could J-Pow cut but QT his brains out? He could pause and QT his brains out. Like I said, forward guidance will be important today, regardless of the rate decision. Yeah, their debt to asset ratio is not as hot as it was. But yeah, I haven't looked at it in a minute either. Is Express a buy here? I've been buying it intermittently, but yeah, I mean I've been accumulating some. It's been pretty fucking cheap. I bought more when it hit like the mid 50 cent range. It's because the ice cream cone tweet. God, I fucking hate Reddit sometimes. I hope it burns itself to the ground. Is the shareholder meeting a good straddle play, or will IV crush after? Um, if Ivy bumps into it, it'll probably crush. Although Ivy doesn't look particularly good right now, anyway. I don't think they're gonna bring up anything at the shareholder meeting that's super consequential. If I buy a straddle right before FOMC 0 DTE, would IV crush and be risky? If I buy a straddle right before FOMC, I mean, IV probably won't crush too much. But generally, I mean, it takes a little while for the IV to crush out for the rest of the day because realized volatility picks up after the, like, into the meeting and through the meeting. Get out of here with your safe trades. What grade would you give JPOW regarding his handling of inflation so far? C. I mean, a year ago I said he should go higher, faster. Near term pain is almost always better than long term pain. Were the longer dated puts being bought a few days ago for next month? For what? Express better to buy after the reverse split? Maybe because you don't know the ratio, especially if shorts come in after the reverse split. Although a reverse split may also be just the opportunity for shorts to get the fuck out. No problem, Darb. I'm so rumbly and my tumbly. Boo. Thank you, Ben. Express as an EXPR? Yeah. Could you expand on the idea of skew as a better bought sold determinant? Yes. You can look it up. If you want, I can send you papers on it. I really don't feel like getting into it. Actually, I really don't even want to do that. Hmm. I could look up most of this stuff. What fun would that be? Well, because I don't feel like handing you anything on a platter. I don't think I've heard much of the express theory. I did a write-up on it not that long ago. You can look it up. It's in Pickles Picks. Seems crazy that VIX is this low going into what could be a pretty volatile FOMC. Yeah. When Express reverse split? They didn't, I don't think they announced a date as far as I know. I bet you'd serve up those covered calls, you'd sell them on a platter. Maybe. I mean, the Craigslist shop is always open. Can you tell me exactly what the market will do when the FOMC decision comes out? If you could serve it up on some sort of a platter, maybe silver. VIX is wild right now. Personally, I've never seen it behave with such positive beta. I have before. Generally, it doesn't last for very long. Usually periods where VIX and SPX are highly correlated, are highly positively correlated, or brief. Honestly, while I'm hedging the downside, I think this is gonna hit 44.90 before end of day. Kind of sarcastic, but not really. Okay. What do we got? We got another hour. I hate FOMC days. Let's go eat. I'm kind of hungry. Possible upstart squeeze if it goes past 40.45. If puts capitulate and the sold call positions close. Otherwise, no. But I got a little extra leverage in case. I have like 200 something covered calls out, so about well, a decent chunk of my position. So I figured I'd get a little leverage in case it keeps moving up. Most of my cover calls are at 30. Well, covered calls and spreads. It's both, actually. The spreads I'll probably roll up, but I want to confirm a breakdown in NASDAQ first. Did you see Biden's pinned tweet? No. I don't. I basically never look at Twitter. It's fucking the worst. I looked at on RRP since May 31st, 180 billion went out of it. So they might actually use it to buy some of the treasuries. You're just picking like the local high on it. All of the treasury auctions have been this month. That was before the fucking like rate decision was even done, or the ceiling decision was over. Thanks to your wealth of knowledge, I've come to learn so much about my newest kink, SPX strangles. So I must ask, for old time's sake, do puts cost same like shares? Well, sometimes they cost same like calls. Devil's advocate, assuming a dovish or neutral stance from JPOW today on forward guidance, how long could the bullish momentum last? How high could SPX theoretically go in such a case? I mean, right now there's not a lot of positioning above like 4410. So that's kind of the upper range for now. I mean, I don't think a pause is particularly bullish. And even if it was, all of that would be priced in already. So what additional value is being added by a pause? GME shareholder meeting is the time when it will be pushed down to $21. It doesn't need much effort to do that, and the volume will die when the price is sitting at the 20-22 range. Yeah, there's a lot of sold calls on the chain that haven't moved at all on GME. It says, good news, inflation has fallen by more than half, bold, since last summer. No, it hasn't. Whatever. Since June 5th, 60 billion went out of on RRP. Yeah, it's not very much money. Even if you take your maximum number there, it'd be a very small amount of money leaving on RRP to cover the treasury auctions. By the end of this week, the total treasury distribution should be like points, what is it, 0.75 billion or trillion. I did some math. Selling cover calls doesn't blow up your port. What the fuck videos? I did some math, and assuming around a 3% return every 2 weeks selling cover calls, in about a year I could live off the premiums. This seems too simple. Am I assuming too great a return? You're not assuming any risk. No, the markets have been a bit weird since the last few weeks. Yeah, we've been zero DT pumping on bearish data while they massively leverage the dealer on the Vega side for any downside move is going to be ridiculous at this point. But I mean, you can't predict irrationality. So what's the point of trying? Like the other day, we were perfectly stable at the JPM collar, and then they came in and bought, a few hundred thousand zero DTE calls. Like you can't see that coming. There's no forward indication that's going to happen, right? It just happens. So the best thing you can do is be prepared for whatever the outcome may be, right? And there are ways to do that. You don't have to be directionally exposed. I just want JPAT to say Volker at least once. Vix went off the bottom. Oh. How disgusted will you be if JPAL pauses and doesn't say anything hawkish about QE? Unsurprised. That doesn't mean the market won't sell off anyway. I think that the presumption here, and this is where the contrarian trade would be. The presumption here is that if JPAL pauses, everything's perfect, and we all go back to normal, and we're in a bull market, and stocks only go up, right? And I think far too many people assume that that's the outcome. 3% is a very good return on cover calls, unless you're timing peaks as well. It requires the same kind of skill as any other form of trading. Low risk covered calls, so sold weekly, have lower yields. That depends on the underlying, right? I mean, it does. It really depends on what you're selling covered calls on. You can get higher yields than 3% a week. It requires understanding the pricing of calls and puts on the chain and which one's more advantageous, and understanding. Yeah, I mean, you still have to have some understanding of support and resistance levels and where a stock is likely to move in the future, because you will take on risk, but um, it's doable. If you're timing the peaks, perfectly, you should be doing a lot better than 3%. I have GME cover calls I sold yesterday at yesterday's high that have already yielded more than that. When was the last time the market was at 52-week high going into an FOMC decision? August? Well, it wasn't at a 52-week high, but it was at a local high. I guess November or December? December 2021? November 2021. It seems like you're expecting a bearish outcome no matter JPA's decision. If he does pause, how long do you think before we realize downside? Well, we have a shitload of in the money and out of the money calls expiring on Friday. We have a fairly significant uh amount of treasuries still to be sold this week. And the settlement for those is ongoing. And we have SLD, whatever may come of that. Thank you for your recession picks. Me? They've done pretty well. Not my favorite thing going into value, but it was cheap at the time. I do prefer to hold growth stocks. But going into this pump, the only growth stocks I had were Google and Amazon. They did well. Or not, AMD, sorry. I sold the Amazon. Well, I sold the AMD and Google as well now, actually. If you prefer to hold growth stocks, how come you don't own any Nvidia? I mean, I was long Nvidia from like 140 up until earnings. Then I went short Nvidia before earnings. I probably should have waited till after. Broke my own rule. Technically, my short position that I bought on Nvidia was way the fuck up going into earnings. And I probably should have just closed it. Do you recall the delta of the Rev 35Cs? It fluctuated, but it was pretty high. If I remember correctly, it was like 0.3, I think. 0.3 to 0.2. Was Nvidia overvalued at 210? Yeah. And 250 and 400. It fluctuated, but yeah, on the high end it was like 0.3, 0.35. I think there were a couple times where it hit 0.4. So the Vega per dollar was very very cheap. And the Vega breakpoint was at like $12. So if Revlon had moved up above $12, the contract would have like quadrupled in value or more. Like Vega just skyrocketed at that point. I think I can't remember that. I know there's posts in the Revlon channel where I like mapped out the Vega curve at the time. If Rev had not get delisted, it would have been a crazy play. Yeah. Yeah, it would have. I mean, it was a crazy play, but playing the delisting itself was where the biggest risk lied, right? I mean, there were people, believe it or not many, but there were people that just scalped the options and made money on it. Well, the delta on my Rev Upstart 100Cs are almost 0.2 now. Nice. The true crime is not buying puts to hedge the delisting. They were expensive. I scalped the options on Rev and made a little money. I went into the Rev channel every day for like a month and told them it was risky and they were going to lose all their money. I know. I told them that too. It didn't matter. Which is sad. Rev was really fun while it lasted. Is Jimmy worth it wheeling? Yeah. I'm trying to figure out what CSPs would be worth selling. I mean, I wouldn't want to sell CSPs on it right now. Puts aren't very expensive currently. Fun was had. I mean, sometimes the risk to reward is high, right? Sometimes you got to take a lot of risk to realize a lot of reward. And the reward potential for Revlon not being delisted for many was worth the risk, I assume. I think most people at the time were well informed of the risk. So the company had actual value and really got shafted by supply chain issues, but even in the end it was still a better company than Bobby. Yeah. I mean it is now, right? It's moved into private ownership. The company is still doing well. Probably better. Can you speak on how you personally sell CCs on your oil stocks? I assume you sell weeklies almost constantly. No, generally like out of the money, like 30 DTE. I try to kind of time the local highs in oil prices, and then um I just saw like 30 DTE or 14 DTE out of the money. You got to sell a little theta on those less volatile stocks. If you're still inexperienced, then sure, go with the weeklies. But um, yeah, I usually sell like 30 DTE on those. The more boring shit I own, I sell more theta on. I just don't sell a lot of theta on shit like GME, right? Because if I have to roll, that is a Head and Shoulders. You're correct, Dork. If I have to roll on something volatile, and I sell a short dated call, that gives me more room to roll it out without overextending myself on theta. So if I sell like 7 or 14 DTE on GME, I can roll to 21 or 30 or 45, and I'll still be okay, right? So I give myself that extra padding to move the position if I need to. But if I'm selling at 45 DT and I get blown out, then I've got to move it out to like 60 or 90, right? And then it starts to get underwater for longer, and you're less liquid. So I try to avoid that on more volatile stocks. How do you see Fubo playing out the rest of this year? Incremental gains as the management continues to accomplish their goals, provided they continue to accomplish their goals. If they fail a quarter, then it'll probably suffer a pullback. But I think they're doing not only what they're incentivized to do, but what they've promised to do so far, right? And so, I mean, that's a lot of the play on Fubo is I've put my faith in the management achieving their goals. And if the management achieves their goals, Fubo will be worth more money than when I bought it. Although I'm pretty close to break even right now. And I've made a lot of money on things like synthetic longs and stuff off of it. There was a little while there where like $1 CSPs were yielding 17%, which was kind of nuts. So, I mean, if you're watching something like that all the time, there's no reason not to take advantage of the price action that you're constantly observing. Ken, not Kenny, welcome to Dillionaire, man. I appreciate it. Hit me up on the Discord. I'll get you added to the country club after the stream, man. I also aim for 30 DTU with 0.3 delta. I've been doing it for a while. I was asking to see if there's something I'm looking at with oil expected to pump through the summer. Yeah, I mean, I think my DVN ones that I have out right now are like 0.2 delta, so I'm ready to pull them back on any big news, right? Like I'm trying to sell them far enough out of the money that if OPEC cuts or OPEC proceeds with a bigger cut than expected, I can get them out of harm's way. You're like Bruce Lee? How? Did you say you rarely let CCs expire? I would say I'd mostly let them expire. On more volatile stuff like GME, they don't expire very often. On most of my other shit, they almost always expire. I've been out of BTU and haven't paid much attention to it. Buy right now or just buy? Looks like it might have bottomed a couple of weeks ago. Whoops. Yeah, there was a pretty good opportunity a few weeks ago. 20 is not bad. It's a little bit above my cost basis, so obviously I tried to take as much advantage of the dip that we did have there as possible. I didn't get assigned on all my CSPs, but I also just bought shares. I don't know. I think if the market continues to perform well over the next quarter, it may get another dip sub 20. You may have another opportunity. But I'd be careful because they do have that buyback, so how much of it's going to be executed is anyone's guess. What's your long-term BTU target? Like 35, 40. I don't think 40 is out of the question. It hit 32 once before, and I sold the position I had at the time. Um, uh, like on in the money CCs, and I think it was like 25, and then it dropped, so I just added to the position again. I sold in the money CCs after it was like the earnings in Fed. It's dropped since then, so I haven't gotten an exit, but I've been open to one above $30. Like I don't want to sell it under 25, right? But above 25 to 30 I would. So when it's gone over 30, I've just sold in the money cover calls. Then if it stays over 30, I cash out, right? If it falls, then I can buy more. And I capture the premium to average down with, right? BTU at 1780 last dip was close to the 52-week low. Yeah, it was. It was quite cheap. And part of that was like flight after the dividend, right? I don't think you're gonna get that price again. But it could if the market rallies a little bit here or next earnings miss. I think the expectations for them are a little higher though. They sell a lot of metallurgical coal, and with contracting, like manufacturing contracting almost globally, that their margins on that maybe hurt a little. So maybe, yeah, maybe the next earnings, next dividend could see a little pullback. Their cash flows are insane. They're a very, very cash heavy business, and I think the dividend's probably going to grow over time. And they're committing to share buybacks. So their current share buyback is 1/3 of their market capitalization, right? Um, and they're already underpriced. Some of that on BT will always exist because coal's not popular, right? Will Jamie ever go sub 20 again? Probably. Has BTU done any cash distributions outside of the 1% dividend? They've done dividends in the past, like back in like 2018, 2019. I think in 2019 they did a special dividend. I think they talked pretty openly about doing an additional special dividend. So yeah, that's possible. I think now that they've got their dividend back on track, it's more likely that we'll see a special dividend, especially with the cash flows, right, that have been coming in. They've been averaging about $500 million a quarter over the last 4 quarters in cash flow, and they've reduced debt by what was it, like 20, about about 20 to 25% every quarter for the last 4 quarters. Yeah, their financials are phenomenal. They're trading, even at $20, they're trading $4 below book value, and that's before the share buyback. But I think BT will always be a little undervalued because it's coal, right? And coal has no place in our green energy future, despite a significant amount of power plants still operating on it. Larry Fink, AI may be the tech that brings down inflation. Well, because everyone loses their job. Yeah, that'd bring inflation right down. 20% of the white collar workforce gets fired at once. I'm a consultant for a coal plant in Alaska. Oh, cool. Do you have all your positioning for FOMC? Yep. I think. Oh, you mean if I entered it all? I might still buy one more straddle, depending on where we end up. That way I could keep some of the gains that I've already gotten. But not yet. I mean, do people understand the outcome of AI? If it does all it's promised to do, which it's currently incapable of, but if it were to do everything it promises it can do, the amount of reduction in requirement in labor would be catastrophic. We could just start listing industries where everyone will lose their job. Do you like a firm? No, no, not really. Not as much as Upstart. A firm was one of the comparables I was using when I was doing my Upstart analysis. They're in similar ETFs. Their business models are not the same. I think a firm is not a good business model, despite their popularity. They're actually not a terribly run company. I just don't like their business model. Well, those industries should see big profits. No, sure. Who's gonna buy their shit? If everyone's out of work, no one has money. Where are you need consumers. You can save all the money in the world firing all your employees, but if there's nobody buying your shit, then you're fucked, right? The AI will buy it. At that point, universal income would become a thing. It would have to, right? But then they're gonna tax. Like the only way to provide that would be to tax corporations for every worker they've replaced with automation, right? Good fucking luck. Not until we chop off the heads of the rich. And we're still far away from ever doing that. If AI gets smart enough, even they won't want to flip burgers below $15 an hour. Any utility companies you watch? Um, I have some telecoms exposure. That's about it right now. Yeah. Utilities are decent though. They're probably pretty cheap right now. I've kept my eye on a few, but they haven't really gone where I want them yet, so I haven't talked about them much. FOMC's at 2 o'clock. Keeping you clean always. See you at 2 p.m. Eastern for the running of the bulls and Nvidia to $2 trillion market cap. Thanks, Gorks Bidet. I feel like I've sipped the bull Kool-Aid too much. Is there any possibility that this just keeps pumping back to Jan 2022 highs It seems like that's where they're hoping to go. What was the high for Jan? Oh, like back up at like 47.50. I mean, I don't see any positioning for that right now. I mean, sure, if you think tech companies are going to grow another 40%. Not sure if it would have an immediate effect, but the actors in the US might start striking July 1st, which would halt all production that is still going despite the writers' strike. Interesting. Like the famous ones? I don't know. Maybe I just play video games all day. 4380 seems to be becoming support. Um 4380 is actually the weakest line of support. Although 4375 might be just so fucking stacked at this point that it's reasonable. Do you think the Fed is going to pause? I don't know what they're going to do. I want to say I expect them to continue to be overly light-handed regardless of the issues that are presenting themselves. When taking profits, do you ever consider holding onto a winner longer to recoup losses from other positions, or is that a bad mentality? That's a terrible fucking mentality. Don't do that. A win is a win, and a loss should be cut as soon as possible. Do you think the Fed will make me rich and younger? I don't know. Yeah, I'm gonna close some of these upstart calls. Maybe not. The protective calls. Well, I don't know. I'm up on the 40s and a little bit on the 45s. I kind of want to scale it back a little bit. I mean, I don't really care if I get assigned, but I'm gonna get slippage if I stop out all at once and the Fed decision's bad. So if I take some profits here, that'll offset any slippage on my stop. That's probably the smart thing to do. It's not the greedy thing. I mean, I kind of want to be a little greedier here. Especially after it just went up 1% since I started talking. I already have long dated puts on FSLR. It's been breaking down for a while. Slowly, but I mean I started getting into puts after their fucking shorter dated puts after their acquisition, and then I got more in like the 210 range. But yeah, I still have 200s and 190s, 180s. 180s and 190s are for September. I will act accordingly to the data as it presents itself. No fucking way will I ever fuck my big bank buddies. What's this? I'm so angry at the market. And I dare you guys to try and guess what my actual job is. He's the biggest bank. If Powell is willing to do a 1% increase, if you were willing to eat an entire pineapple pizza in the slums of New Jersey, would you do it? No. I'd rather lose my money. Jan Upstart 200C and 350C are moving today. Picking up some delta. The Fed is a bank? God damn it. Alright, I'm gonna get something to eat before we get into all the Fed shit in an hour. I'll be right back, guys. That was fun. How's everyone doing? Sorry about the delay there. I was only going to be gone a minute, but oh, I see Vix went back up. What are we eating? I actually ended up making a sandwich. I ordered food and then I went to go grab it and it wasn't ready. And then they dicked me around for like 20 minutes and it still wasn't ready. So I just came back home and got food. But then I got back home, the elevator was shut down for maintenance. So I had to come up the stairs. No, the snail didn't get me. You left your positions unattended? I have a cell phone. So 0.25 in Dovish, maintaining the course. That's interesting. We'll find out in 2 minutes. What if they cut bearish? $20. At least I made it back in time. What if it just doesn't matter what the fucking rate cut is? Hold on, I'm refreshing. Ah. Recent indicators suggest that economic activity has continued to expand at a modest pace. Job gains have been robust in recent months, and unemployment rate has remained low. Inflation remains elevated. The U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain, and the committee remains highly attentive to inflation risks. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. In support of this goal, the committee decided to maintain the target range for federal funds rate at 5 to 5.14%. Holding the target range steady at this meeting allows no change, allows the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return to inflation to 2% over time, the committee will likely take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In addition, the committee will continue to reduce its holdings of Treasury securities and agency debt and agency mortgage backed securities, as previously described in announced plans. The committee is strongly committed to returning to inflation to its 2% objective. Interesting. Okay. So, no, not pause QT. Well, yeah, pause plus QT. Hmm. Hold on. I need to look at their last meeting. Okay, so the mortgage-backed securities wording isn't different. They've included the wording of it, even though they said they weren't going to sell any. So I guess we'll see what guidance looks like. I need to look at the implementation note. Okay. Effective June 15th, 2023. Undertake open market operations as necessary to maintain the federal funds rate in a target range of 5 to 5.25%. Conduct standing overnight repurchase agreement operations with a minimum bid rate of 5.25% with an aggregation operation limit of 500 billion. Conduct standing overnight reverse repurchase agreement operations and offering of 5.05 with per counterparty limit of 160 billion per day. Rollover at auction the amount of principal payments from the Federal Reserve's holding of Treasury securities maturing in each calendar month that exceeds a cap of $60 billion per month. Redeem Treasury coupon securities up to this monthly cap, and Treasury bills to the extent the coupon principal payments are less than the monthly cap. Reinvest into agency-backed mortgage securities the amount of principal payments from the Federal Reserve's holdings of agency debt and agency MBS received in each calendar month that exceeds a cap of 35 billion. Allow modest deviations from the stated amounts for reinvestments if needed for operational reasons. Engage in a dollar roll and coupon swap transactions as necessary. In related action, the Board of Governors of the Federal Reserve System voted unanimously to approve the establishment of the primary credit rate at the existing level of 5.25%. Hold on, I'm working my way through all the paperwork. So median forecast for the federal funds rate is now 5.6. Ooh. Hold on. I need to find their projections for distribution of assets. They're projecting higher risk to GDP. PCE inflation is highly uncertain. Change in real GDP expectations drop. Unemployment rate kind of flat. PCE inflation or PCE. All right. Diffusion index of participants' risk weightings. Hold on, I'm trying to find. So the Fed's saying 1.5% growth this year versus the estimate, which was higher. Unemployment rate they expect to rise by 0.8, plus or minus 0.8, I guess. Did we find the page with the quantitative tightening projections, or is that not in here? Or that'll be in the minutes? Yeah, midpoint projected for the target range is slightly higher. We'll change GDP. Oh, so they're projecting unemployment at 4.5%. 4.6% into next year. Yeah, no information on this on the quantitative tightening conditions. I mean, I don't know if it's a fake dump at this point. Right? We're not at 3% right now. We're a little higher. SLD sell off at the top. Maybe that was a very one-sided drop. I'm sure someone will go back and get their $1 billion worth of calls, right? Oh no, now we can giant fake pump again. Oh, now the bulls are calling it a cloud market? Let me look at 0 DTE positioning. Looks like everything above 43.75 got stopped out bigly. 43.50 put interest is massive. Might be SLD selling before guidance. Raising the target range is interesting. Not what I expected them to do. No, it's bearish. I'm trying to think of the effect on certainty. Raising the target range means this is a hawkish pause. Yeah. The market's not going to like the Fed sitting on a bunch of extra hikes that they can deploy. Hmm. I thought SOFR had the target rate higher. Yeah, but that doesn't mean the Fed did, right? Generally that means SOFR might move theirs like inflation swaps, right? May go even higher. They may price in more, right? I mean, it took them all the way into last month to even price in anything but cuts for this year. It's bearish. Does that mean the market will react bearishly? That's a good question. Because, well, we're at a technical top. We've blasted through every resistance on just this non-stop run with no pullback, right? Leverage to continue selling short puts is dwindling. So there's reasons for the market to pull back that have nothing to do with the Fed. I don't have a lot of faith that inflation swaps are going to price in a higher target rate right away, but they could. They did last year when they were still uncertain and we'd yet to reach the Fed's goal, right? Hmm. I'm not sure that the market can withstand the sell-off. The entire options chain is sold puts all the way down. What was the old target rate? It was, I think it was 5.15, the last one they announced. But then they abandoned that and went with the 0.25 hike, which brought us to 5 to 5.25, which is still where we're at. But we haven't moved above 5.15. But now we can, right? They've moved the target rate. Well, there's a few $1 billion in calls that are very far out of the money right now that expire today. I'm holding 20 of those calls. Me too. Thanks to my incredible trading prowess, my daily P&L is +2. Nice. Yeah, not good for Upstart. Continued uncertainty in the rate environment. More call positions selling off. Hmm. We're still far away from the short puts. The majority of them, at least. There's a lot at 4,300. IXIC's down 770 BPS. Oh, fuck. Did I get stopped out of my Upstart calls? Awesome. Jesus. Fix? What about it? I had a lot of Upstart calls, but I had a stop limit on them, not a stop loss. I was afraid I got gapped over there for a second. That would have really fucking sucked. See, if you guys remember earlier, I was like, I'm going to cut a few of these so I don't lose so much money on slippage with my stop, right? That's the kind of thing that you want to do when your position's in a lot of risk, right? The stop protects you. But taking that little extra money off the table means that, you know, the cost of holding and all of that are, you know, offset. Yeah, there's no rate hike. I know it's pure speculation, but how can Powell frame the cause for the pause? Well, he can put claws on the pause by raising the forward rate. Sorry, I had to. Um, I mean, they're holding, right? Against all of the market participants' wishes. So we're maintaining the rate. They're raising their projected rate for the year to 5.6. And even with that, they've had to raise their inflation expectations and unemployment expectations for the next 2 years. So they're saying this is, I mean, the dot plot's kind of saying this is still fucked up. It's going to get more fucked up. And we're going to act appropriately to handle that. I mean, I don't think we've even had enough time since the first rate hike to feel any of the big credit effects, right? Lenders are still giving away money. Yeah, I'm going to get the JPAS speech loaded up here in a second. This is interesting, especially with the market position the way it is. Oh man, this the questions from the press are going to be a minefield today. $7 minutes till the speech. I'll put it on as soon as he starts walking up. Sometimes he's a little early. I'm thinking about applying for an FA job at Northwestern Mutual. Any advice? I mean, I don't know what they're going to require for. I've never been a financial advisor. Not in that kind of role. Um, Dress the part. Prepare yourself for questions. Have you got an interview, or are you just applying? I mean, get an interview first. Don't have face tattoos. Yeah, that'd probably help. Yeah, make sure you have questions to ask them. Dress the part while applying. Let's say JPAL comes out hawkish and those sold puts at 4,300 capitulate. Clearly 4,250 is next, but then VIX might rise and then they start this all over again. This shit is maddening. Or VIX just jumps, right? They get fucked and their puts blow up the same way covered calls have been blowing up for the last 2 weeks. Goes both ways. Entropy. Do you have any licensing requirements? Yeah, I'm pretty sure they Poopy Pants is right. They'll hire anybody. I mean, it's a very sink or swim position, right? You're either successful at it and you're able to build a good book, or you're not. If you are, you're very valuable to them. If you're not, then they haven't really lost any money in the attempt. I've been screaming tail risk into the sky ever since the minutes were released. Nice. No forward guidance, read the presser. That would be chaos. You're either successful or you hang out and chat all day. I mean, I know a few successful FAs and they don't do a lot. So I feel like you could be both of those things and simultaneously accomplish those goals. You just got to find the right group of 60 to 75-year-olds who you can trick into paying you 0.5% on your 4% returns, right? It doesn't seem that complicated. Sorry, that's biases from my old life. I'm sure you guys work really hard. Shh. No, I mean, you're 100% accurate. I know I am. It's very easy to return half of the S&P every year, right? If you can beat that, if you can return 5% every year, even on the years when the S&P does poorly, you're perfect as a financial advisor. Like, you'll kill it. It's not a high bar. That's why hedge funds are expected to do better than the S&P, right? Their clients are a lot more annoying, though. Just start using a structured note as outlined in options as a strategic investment. Clients will think you're a god. Are you holding your calls or did you cut them? I'm holding them. I'm not fucking around. I hope they die, but I'm holding them. I think the little straddles stopped out, but I still have my main one. Like the zero DTs, like, well, strangles. Oh, here he comes. Entering from stage right. You're gonna be running the bean stand for the presser? You need a job, dork? I gotcha. It's not gonna pay money, but your needs will be taken care of. All right. No problem.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2%
Tie
goal.
is purple.
Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. And I will have more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer-run normal growth rate. The labor market remains very tight. Over the past 3 months, payroll job gains
But NVIDIA is
averaged a
supposed to
robust
grow 10x next year.
283,000 jobs per month.
Hold on.
The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer-run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the Consumer Price Index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves
Same
as
like
projected,
YouTube
the
poll?
median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a half percentage point higher than in our March projections. I hasten to add, as always, that these projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Colby. Thank you. Colby Smith with the Financial Times. I'm curious what gives you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated. Interest rate sensitive sectors like housing, while they felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
So, I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were 3 issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not decide or really discuss anything about going to an every other meeting kind of an approach or really any other approach. We really were focused on what to do at this meeting.
So there was no kind of initial debate about the possibility of July, any sense of the initial support at this stage for that move?
So again, we didn't make a decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July 2 things. 1, decision hasn't been made. 2, I do expect that it will be a live meeting.
Thanks, Howard Schneider with Reuters. I was just wondering if you could help us understand the narrative here, because it feels like there's been unemployment, slower progress on inflation, and I'm wondering, in this sort of, where's the disinflation coming from?
Sure.
The labor market's going to be stronger, it looks like. It's not coming from there. Demand's not coming down all that fast, according to GDP. You've doubled your estimate of GDP. So what's the narrative here? It seems like it's getting more immaculate rather than more messy.
So you're right that the data came in, I would say, consistent with, but on the high side of
Just refresh
expectations. So, and if you go back to the former SEP, the last SEP in March, you will see that growth moved up. These are not huge moves, but growth estimates moved up a bit. Unemployment estimates moved down a bit. Inflation estimates moved up a bit. And, all three of those kind of point in the same direction, which is, that perhaps more restraint will be necessary than we had thought at the last meeting. So although the level, frankly, is pretty, the level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So we've kind of gone back to that. So your question is, where's the disinflation going to come from? And I don't think the story has really changed. The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. It's going to take some time. And I think you go back to the three-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see continued healing in supply conditions, supply-side conditions. They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation to continue to come down over time. In terms of housing services inflation, that's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any forecast that people are making right now about inflation coming down this year will contain a big dose of this year and next year, will contain a good amount of disinflation from that source. And that's, again, probably going to come slower than we would expect. That leaves, the big sector, which is a little more than half, pardon me, of core PCE inflation. That's non-housing services. And, we see only the earliest signs of disinflation there. It's a sector, it's a very broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive. And I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions, which we have seen. We have actually seen, I go through a number of indicators suggesting there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time.
Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, what's the value in pausing and signaling future hikes versus just hiking now? I mean, not to be flippant, but I don't lose weight just by buying a gym membership. I have to actually go to the gym. 16 of your colleagues put down a higher year-end 23 rate today. A majority of you think you're going to have to go up by 50 basis points this year. So why not just rip off the Band-Aid and raise rates today? So
first I would say that the question of speed is a separate question from the question from that of level. Okay, so and I think if you look at the SEP, that is our estimate, our individual. It's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting. It's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting. And so
yeah, he definitely
the committee
has
thought overall that it was appropriate to moderate the pace, if only slightly. And there are benefits to that. So that gives us more information to make decisions. We may try to make better decisions. I think it allows the economy a little more time to adapt as we make our decisions going forward, and we'll get to see. We don't know the full extent of the consequences of the banking turmoil that we've seen. It would be early to see those, but we don't know what the extent is. We'll have some more time to see that unfold. I mean, it's just the idea that
I thought the banks were stable and resilient.
This is, if you think of the two things as separate variables.
What else is going to unfold?
The skip, I shouldn't call it a skip, the decision makes sense.
I know you said July is live with only one June employment, with only the June employment and the CPI report for June due to be released before the July meeting. You get the ECI after, you get the senior loan officer survey after, you get some bank earnings at the end of next month. What incremental information will the committee be using to inform their judgment on whether this is in fact a skip or a longer pause?
Well, I think you're adding that to the data that we've seen since the last meeting, too. Since we chose to maintain rates at this meeting, it'll really be a 3-month period of data that we can look at. And I think that's a full quarter, and I think you can draw more conclusions from that than you come from any 6-week period. We'll look at those things. We'll also look at the evolving risk picture. We'll look at what's happening in the financial sector. We'll look at all the data, the evolving outlook, and we'll make a decision.
Gina.
Thanks for taking our questions. Gina Smilek, New York Times. You obviously, in your forecast, marked up the sort of path for growth, marked down the path for unemployment, and marked up the path for inflation pretty notably. I wonder, since March, what has changed to make you think that the economy is a lot more resilient and inflation is going to be a lot more stubborn? And given that, why do you feel confident that this is as high as you're going to have to revise the federal funds rate, or do you think it's possible we could have even a higher than 5.6% terminal by the end of this cycle?
I mean, on the first part, I just think we're following the data and also the outlook. The economy the labor market, I think, has surprised many, if not all, analysts over the last couple of years with its
most important
extraordinary
piece of this
resilience, really.
presser,
And,
J-Powell believes 3 months equals a full quarter.
It's just remarkable, and that's really, if you think about it, that's what's driving. It's job
He's a
creation.
lawyer.
It's wages moving up. It's supporting spending, which in turn is supporting hiring, and it's really the engine, it seems, that is driving the economy. So it's really the data. In terms of, we always write down at these meetings what we think the appropriate terminal rate will be at the end of this year. That's how we do it. It's based on our own individual assessments of what the most likely path of the economy is. It can actually, in reality, wind up being lower or higher. And there's really no way to know. But it's what people think as of today. And as the data come in, it can move around during the intermeeting period. It could wind up back in the same place. But it really will be data driven. I can't tell you that I ever have a lot of confidence that we can see where the federal funds rate will be that far in advance.
Mr. Chairman, thanks for taking my question. You had said back at the end of May that you thought risks were getting closer to being into balance. Is that still the case, or has your mind changed about the balance of risks out there? And also, could you give us an idea of what would be a sufficiently restrictive funds rate? Obviously the current rate, according to the committee, is not sufficiently restrictive. Is it 5.6? Is it 6? Where's for sufficiently restrictive? Thank you.
I would say again that I think that over time, the balance
it's
of
not
risks,
just any
as
3
we move
months.
from from interest rates at effectively 0 now to 5 percentage points with an SEP calling for additional hikes. I think we've moved much closer to our destination, which is that sufficiently restrictive rate. And I think that means, almost by definition, that the risks of sort of overdoing it and underdoing it are getting closer to being in balance. I still think, and my colleagues agree, that the risks to inflation are to the upside still. So we don't think we're there with inflation yet, because we're just looking at the data. If you look at the full range of inflation data, particularly the core data, you just aren't seeing a lot of progress over the last year. Headline, of course, inflation has come down materially, but as you know, we look at core as a better indicator of where inflation overall is going. So I think what we'd like to see is credible evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see. And I think it's also, we understand that there are lags, but remember that it's more than a year since financial conditions began tightening. I think the reason we're comfortable pausing is that we are still.
Why are you assuming
much of the
anything
tightening
that's
took
going
place
on
over
right
last
now is
summer
anything more than
and later into the
repositioning?
year, and I think it's
That's
reasonable
all
to think
this
that some
is.
of that may come
Don't
into
look-
effect. So we're
Don't look for the
stretching
price
out
action during the
into a more moderate
FOMC
pace is appropriate
press
to
meeting
allow
to
you to
give
make that
any
judgment of sufficiency,
indication of direction
more-
of the market
with more
over the
data
next
over
few
time.
days. Because it means nothing. It generally drops and bounces and drops again.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our
What the fuck was
questions.
that?
I wanted to ask further on the lag effects. When you're considering when you would
It's during
hike again
storms.
throughout the course of the year, are there things that you would expect to kick in as those lag effects come into effect that would inform your decisions? Have you learned things over the past year that give you some sense of timeline for when to expect those lags to come into effect?
Yeah. So.
Lightning.
It's a
New York
challenging,
City lightning. Let's see if it scares the
thing in
bulls.
economics. It's
Thunder
sort
and
of
lightning.
standard thinking that monetary policy affects economic activity with long and variable lags. Of course, these days, financial conditions begin to tighten well in advance of actual rate hikes. So if you look back when we were lifting off, we started talking about lifting off. By the time we had lifted off, the 2-year, which is a pretty good estimate of where policy is going, had gone from 20 basis points to 200 basis points. So in that sense, tightening happens much sooner than it used to in a world where news was in newspapers and not on the wire. So that's different, but it's still the case that what you see is interest-sensitive spending is affected very, very quickly. So housing and durable goods and things like that. But broader demand and spending and asset values and things like that, they just take longer. And you can pretty much find research to support whatever answer you would like on that. So there's not any certainty or agreement in the profession on how long it takes. So, and that makes it challenging, of course. So we're looking at the calendar, we're looking at what's happening in the economy, we're having to make these judgments. And again, it's one of the main reasons why it makes sense to go at a slightly more moderate pace now.
Did you time him out for typing Galileo?
Yeah, I can't point to that ultimate endpoint. I can't point
All
to
right.
a specific
Do you?
data point. I think we'll see it when we see inflation, really, really flattening out reliably and then starting to soften. I think we'll know that it's working. And ideally, by taking a little more time, we won't go well past the level where we need to go.
I was curious if you could give us an update on what you're seeing on credit tightening since the bank incidents from March and how you're teasing that out apart from these lag effects.
So it's too early still to try to assess the full extent of what that might mean. And that's something we're going to be watching, of course. And if we were to see what we would view as significant tightening beyond what would normally be expected because of this channel, then we would factor that into account in making rate decisions. So that's.
Did he type something
how we think about it.
else?
Let's go to Chris.
Thanks. Chris Rugaber at Associated Press. You mentioned that many of the trends are in place that you want to see. Core services ex-housing has come in pretty low in the past couple of months. And as you noted, a significant portion of core inflation is now housing prices. And then we've had some quirks in used car prices. So given that these trends are in place,
I
guess
got
I'm sort of
Mako
asking
for
the flip,
saying someone's
side of Nick's
tonsils look
question,
soft.
Why signal additional rate hikes? Aren't things headed in the direction you need? Why not simply give it even more time? Or it's surprising to see so much hawkishness in the dots, given what we're seeing recently.
Yeah, so, we've.
I got you,
remember
sloppy
we've,
poppy.
We're 2.5 years into this, or 2.25 years into this, and forecasters, including Fed forecasters, have consistently thought that inflation was about to turn down, and typically forecasted that it would, and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running at a level, over 4.5%, far above our target, and not really, moving down. We want to see it moving down decisively. That's all. Of course, we are going to get inflation down to 2% over time. We don't want to do. We want to do that with the minimum.
Say it
damage
again
we
and
can
say
to the
core
economy, of course,
PCE,
but we have to
not
get inflation
core
down to 2%, and
CPI.
we will. And we just don't see that yet.
Is he going to
So,
address the fact that
hence you see
producer
today's policy
inflation
decision
is about
both
to move
write
below
down further
2%?
rate hikes by the end of this year, but also to, to take, to moderate somewhat the pace with which we're moving.
Quick follow-up. I mean, the last press conference you mentioned you didn't see wages
I got
driving
stopped out of some
inflation,
pits
and,
close to
there
the
was some
bottom.
research from the San Francisco Fed suggesting wages aren't necessarily a key driver, but you've talked about the labor market today and the need for softening. Can you give us a little more specifically of how you see the tight labor market
Kinda
driving
like
inflation at this point?
Over
Thank you.
here.
Right. So
Well,
I'm not going to comment on any
Right
particular
there
paper,
specifically.
but I would say that I think the overall picture is that at the beginning, in early 2021,
We don't have a seat at the table, which
inflation was
I
really
know, it's
coming
bullshit,
from very
right?
strong demand for
we
largely for
cover
goods.
we
People
cover
were still at
the
home.
macro environment for
They had
all
money in the
700
bank,
retail
and they wanted to
investors that
spend.
care
They
about
spent
it.
a lot on goods, and of course, at the same time, and because of that high demand, to some extent, supply chains got all snarled up. So prices went way up, inflation went way up. So that was the origin, and it wasn't really particularly about the labor market or wages. But as you moved through 21 into 22 and now in 23, I think many analysts believe that it will be important, an important part of getting inflation down, especially in the non-housing services sector, to getting wage inflation back to a level that is sustainable, that is consistent with 2% inflation. We actually have seen wages broadly move down, but just at a quite gradual pace. So, and that's a little bit of the finding of the Bernanke paper with Blanchard of a few weeks ago, which is very consistent with what I would think.
Oh God, is JPOW reading
Michael McKeever,
papers
Bloomberg
written by
Radio and,
Bernanke?
Television. You said in the past that you don't like to surprise markets. It's kind of been the Fed's view. Markets should have an idea of what you're going to do
Oh, it's
before
this
you
guy.
go in. You also said a number of times that it would take a while to bring inflation down. You reiterated that again today, and that we would get to a point where inflation could be sticky. So I'm wondering, as we go into the next meetings, how Wall Street or others should look at your reaction function. What will you be reacting to, time or data? In other words, if nothing much changes, if we're looking at the same sort of labor market, the same sort of inflation levels in July or
Say
in September
stagflation.
Or November, will you move?
Say it.
Because you've
Come
said
on.
you feel you need to?
Come
Is
on,
it
Big
time
Putz
that's going
Mike.
to require additional movement, or would it be a reversal in inflation?
You know what you meant
I
to
don't want
say.
to deal with hypotheticals about different ways
Oh,
data
you-
might
oh, I
move.
don't- you wanna talk about
of course, we don't
stagflation?
go out of our way to surprise markets or the public. At the same time, our main focus has to be on getting the policy right, and that's what we're doing here, and that's what we'll do for the upcoming meetings. I will say the July meeting will be live, and we'll just have to see. I think you'll see the data, you'll hear Fed people talking about it, and markets will have to make a judgment.
Well, do you think inflation is likely to continue coming down based on the lags and based on your threat of additional movement? Or are we going to be in a period where we're not going to know what's happening?
I think if you look at, if you just look at, I'll just point you to the forecast. So inflation is running, core PCE inflation is running at about 4.5%, a little higher than 4.5%, and the median FOMC participant thinks it'll go down to 3.9 on a 12-month basis. This is by the end of this year. So that's expecting pretty substantial progress. That's a pretty significant decline for half a year. So that's the forecast. We do try to be
guys have
transparent
been
in our
great at
reaction
meeting
function.
those.
We're committed to getting inflation down, and that's the number one
3.9
So,
by
that's how
December
I think
is
about it.
still stagflation. Come on, JPOW.
Victoria Guido with Politico. Could you talk about the balance sheet and how you're thinking about it? What are you looking for?
Is everyone
to
a fucking
judge whether
bear?
We're approaching reserve scarcity, and is Treasury issuance going to affect that?
need to buy more calls.
Also, are you considering lowering the RRP rate in order to take some pressure off banks?
So let me say, first of all, on the Treasury part of it, if I can talk about that, and then go back to the balance sheet. So on that, of course, we've been very focused on that for a couple of months, as everyone has. Treasury has laid out its borrowing plans publicly. I think I saw the Secretary's comments yesterday to the effect that Treasury has consulted widely with market participants about how to avoid market disruption, and that they're going to watch carefully for that. So That's from the Treasury, which actually sets the borrowings. At the Fed, we'll be monitoring market conditions carefully as the Treasury refills the TGA. The adjustment process is very likely to involve both a reduction in the RRP facility and also in reserves. It's really hard to say at the beginning of this which will be greater. We are starting at a very high level of reserves and still elevated RRP to take up, for that matter. So we don't think reserves are likely to become scarce in the near term or even over the course of the year. So that's the Treasury part of the answer. We will, of course, continue to monitor conditions in money markets, and we're prepared to make adjustments to make sure that monetary policy transmission works. Was there another part of your question?
Yeah, what, are you considering lowering the RRP rate to help take some pressure off banks?
So we have a number of, I would say, the RRP doesn't look like it's pulling money out of the banking system. It's actually been shrinking here lately. So I don't think, that's not something we've thought about a lot over time. It doesn't really look like that's something that we would do. I think it's a tool that we have. If we want to use it, we can. There are other tools we can use to address money market issues, but I wouldn't say that that's something that's likely that we would do in the near term.
Janelle Marte with Bloomberg. Have you seen sufficient cooling in the housing market to bring inflation down? For example, how does the recent rebound affect your forecast, and how does it factor into monetary policy?
So certainly housing, very interest sensitive, and it's the first place really, or one of the first places that's either helped by low rates or that is held back by higher rates, and we certainly saw that over the course of the last year. We now see housing putting in a bottom and maybe even moving up a little bit. We're watching that situation carefully. I do think we will see rents and house prices filtering into housing services inflation, and I don't see them coming up quickly. I do see them kind of wandering around at a relatively low level now, and that's appropriate.
Do you think you'll have to target that with further rate increases?
Well, I think we look at everything. We don't just look at housing. So I think, the way it works is individual participants sit in their offices all over the country, and they write down their forecast, and including their most likely forecast, including their rate forecast, and then they send it in on Friday afternoon, and we accumulate it, and then we publish it for you.
Why are you talking about
So
procedure?
That's how they do that. Well, I don't know that housing is itself going to be driving the rates picture, but it's part of it.
Let's go to Edward.
Thank you for taking the question, Mr. Chairman. Edward Lawrence with Fox Business. So I want to go back to comments you made about, in the past, about unsustainable fiscal path. The CBO projects the federal deficit to be $2.8 trillion in 10 years. The CBO also says that federal debt will be $52 trillion by 2033. At what point do you talk more firmly with lawmakers about fiscal responsibility? Because I'm assuming monetary policy cannot handle alone the inflation or keep that inflation in check with the higher level of spending.
I don't do that. That's really not my job. We hope and expect that other policymakers will respect our independence on monetary policy, and we don't see ourselves as the judges of appropriate fiscal policy. I will say, and many of my predecessors have said, that we are on an unsustainable fiscal path, and that needs to be addressed over time. But I think trying to get into that with lawmakers would be kind of inappropriate, given our independence and our need to stick to our knitting.
Is there any conversation then about the Federal Reserve financing some of that debt that we're seeing coming down the pike?
No, under no circumstances.
Courtney.
Thanks for taking our questions, Chair Powell. So looking at the SEP, it looks like GDP for this year was raised significantly, your forecast for GDP this year. The unemployment rate, meanwhile, was pulled downward. And so should we take that as a sign that the committee is more confident about the prospects of a soft landing, at least as it relates to what you were expecting in March?
You know, I would just say it this way. That I continue to think, and this really hasn't changed, that there is a path to getting inflation back down to 2% without having to see the kind of sharp downturn and large losses of employment that we've seen in so many past instances. It's possible. In a way, a strong labor market that gradually cools could aid that along. It could aid that along. But I guess I want to come back to the main thing, which is, though, simply this. We see, the committee, as you can see from the SEP, the committee is completely unified in the need to get inflation down to 2%, and we'll do whatever it takes to get it down to 2% over time. That is our plan. And you know, we understand that allowing inflation to get entrenched in the U.S. economy is the thing that we cannot allow to happen for the benefit of today's workers and families and businesses, but also for the future. Getting price stability back and restored will benefit generations of people as long as it's sustained, and it really is the bedrock of the economy, and you should understand that that is our top priority.
Just a quick follow-up on that. I'm just a little confused because you said the committee will do whatever it takes to get inflation down over time. But when I look at the SEP, inflation is still projected to be elevated next year, but the Fed funds rate is lower than where it is now. Can you help me understand that?
Sure. So, you know, if you look 2 and 3 years out with the forecast, first of all, I wouldn't put too much weight on
out of the money
forecasts
gamma still
even 1
weak.
year out, because they're so highly uncertain. But what they're showing is that as inflation comes down in the forecast, if you don't lower interest rates, then real rates are actually going up, right? So just to maintain a real rate, the nominal rate at that point 2 years out, let's say, should come down just to maintain real rates. And actually, you know, since we're probably going to, we're having real rates that are going to have to be meaningfully positive and significantly so for us to get inflation down. That probably means that certainly means that it will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate if you think about it. Inflation has not really moved down. It has not so far reacted much to our existing rate hikes, and so we're going to have to keep at it.
Julie.
Maestro.
The mic is coming. Oh, sorry. Thank you. Hi, Chapel. Julie Chabanas, AFP.
Is he just watching the S&P? Like, is someone
major
holding it up for him?
Showed a rebound in May in black workers' unemployment. Is it consistent with the Fed's maximum employment mandate? Are you worried about that, about this rebound?
So we are, of course, worried about, there are long-standing differences in racial and ethnic groups across our labor market. That's a factor that we can't really address with our tools, but we do consider that when we're thinking about what constitutes maximum employment. It is for us a broad and inclusive goal. And so we do watch that. But remember, all unemployment, including black unemployment, has been bouncing around right near historic lows, historic modern lows here. So we're still talking about, I mean, what is as strong a labor market as we've seen in, you know, a half century here in the United States. So overall unemployment of 3.7% is 0.3 higher than it was measured to be at the last a month ago, but still it's extraordinarily low. And so it's a very, very tight labor market.
Megan.
Thank you. I want to follow up first a little bit just on the rent question on housing. We heard Governor Waller talk about how, I'll back up, we haven't quite seen the slowdown in rents show up in CPI yet, and we did hear Governor Waller talk about how an uptick in housing might mean that there's not going to be as much relief coming or a shorter bit of relief than we thought. Can you talk about how you're thinking about that and how that played into today's outcome?
I wouldn't say, so that's, as a factual matter, that's correct. We do need to see, rents bottom out here or at least stay quite low in terms of their increases, because we want the, we want inflation to come down, and rental is a very large part of the CPI, about a third, and it's about half of that for the PCE. So it's important, and so it's something that we're watching very carefully. It's part of the overall picture. I wouldn't say it's the decisive part, but take a step back. What you see is look at core inflation over the past 6 months, year. You're just not seeing a lot of progress, not the kind of progress we want to see, and it's hard to avoid that. And the committee, people in the committee, the median went up significantly, so that the median participant now thinks that core PCE inflation on a 12-month basis will be 3.9% this year. So once again, every year for the past 3 years, it's gone up over the course of the year, and it's doing that again. So we see that, and we see that inflation forecasts are coming in low again, and we see that tells us that we need to do more. And so that's why you see the SEP with where it is.
Could you also talk briefly about your outlook for wages, and given the recent slowdown in core services excluding housing, how far you think wages might need to fall in order to get inflation back in line?
So wages will continue to increase. So what we're talking about is having wage increases still at a very strong level, but at a level that's consistent with 2% inflation over time. And so I think we've seen some progress. All of the major measures of wages have moved down from extremely elevated, not extremely, but highly elevated levels a year or so ago, and they're moving back down, but quite gradually. And we would want to see that process continue gradually. Of course, it's great to see
some out of the money call profit taking,
for people at the low end of the income spectrum. But we want that as
43.85,
part of the process of getting
43.90.
inflation back down to 2%, which benefits everyone. I mean, inflation hurts those same people more than anyone else.
43.75 is still the focal point.
Are hurt the worst and the fastest by high
but
inflation.
all of the call positioning around it is significantly weaker than earlier. I would say positions have reduced by about 50, 60%, maybe a little more.
I just wondered if the committee has talked at all about the labor.
But there was some
market
profit taking on the
there's
zero
strikes
DTE
now
side.
in Hollywood, and now the United Auto Workers are talking about a possible strike. I mean, aren't workers? We have some workers have power now and are going to be seeking higher wages. Does that come up in your discussions? Thanks.
So the topic of wages in the labor market and dynamics in the labor market is about as central a topic to our discussions as anything. I mean, it's very labor economics, and the labor market are utterly central. It's half of our mandate, so we spend a lot of time talking about that. I think there are structural issues that are really not for the Fed. And so we don't spend a lot of time, although we take notice of what's going on. But we're not involved in discussions or debates.
This guy said he's from Market Watch. Does that mean he's a bot?
But we look and we see what's going on, and we're making judgments about what it will take to get inflation down to 2%.
I need to learn something
As I
from
said,
J-Pal.
Don't think that was about. Most folks would say now it wasn't really about wages at the beginning. And it's becoming more about that as we get into really service sector inflation, which is the part of the economy where we have seen the least progress.
Let's go to Mark for the last question.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. Wondering what your thoughts are now about systemic risk now that we're about 3 months past the failure of Silicon Valley Bank, and also specifically, what are the risks associated with commercial real estate as well as non-bank financials, and could you further elevate those risks with higher still rates, possibly for longer?
So, where to start? I'll start with commercial real estate. Of course, we're watching that situation very carefully. There's a substantial amount of commercial real estate in the banking system. A large part of it is in smaller banks. It's well distributed. To the extent it's well distributed, then the system could take losses. We do expect that there'll be losses, but there'll be banks that have concentrations, and those banks will experience larger losses. So we're well aware of that. We're monitoring it carefully. It feels like something that will be around for some time, as opposed to.
You mean it's fucked?
Something that will suddenly hit and work its way into systemic risk. In terms of non-bank financial sector, there's been a ton of work, and clearly in the pandemic, it really was it was the non-bank financial sector where issues really arose, and there's a lot of work going on with the administration, in particular, leading that to try to address issues in the treasury market and in all kinds of areas in the non-bank financial market. But our jurisdiction at the Fed is over banks, actually bank holding companies and some banks. So that's really our main focus. In terms of the events of March, as I mentioned earlier, we will be carefully monitoring that situation. Our job generally involves worrying about a lot of things that may go wrong, and that would include the banks. It might be hard for me to identify something that we don't worry about rather than that we do worry about. So we're watching those things very carefully. And as we see things unfold, as we see what's happening with credit conditions and also all the individual banks that are out there, we'll be able to take, to the extent it's appropriate, we can take, if there are macroeconomic implications, we can take that into account in our rate setting. And so I guess that's what I would say.
Can I just follow up on the last part? That's do you risk further exacerbating those issues if you get up to another 50 basis points?
So that's, and I guess I meant to address that by saying, as we watch, we'll see what's happening, and if we're seeing the kind of tightening of conditions that you could be referring to, then we can factor that, because really we use our rate tool it really has macroeconomic purposes, so we'll take that into account. Of course, we have responsibility for financial stability as well, and that also is a factor that we're always going to be considering. Thank you very much.
Well, highlighted a lot of CMBS risk there at the end. I wish he delved a little bit more into what specific thing they're monitoring in the treasury market. Maybe massive short positions. I mean, it doesn't... I don't think anything in this meeting paints the picture that bulls want to see. But I'm not entirely sure it paints the picture bears want to see either. He managed to say a lot of nothing, which is impressive, but I guess in a way he's a politician. I did a treasury short thesis video. Well, I don't know. They've raised the target rate. They've created uncertainty. They've created certainty that rates aren't going down this year. That's a hard blow. Their unemployment projections are up. I don't see the doubling that guy was referring, that one reporter was referring to in the GDP estimates. I think their GDP estimates are roughly in line, and still a little above actual GDP expectations, but They didn't increase quantitative tightening. It's supposed to continue at the same pace. So no change to QT. Call positioning softened a lot. I mean, it's stagflation, right? They're projecting real interest rates at 3.9% by the end of the year, which is still, you know, massively above their prior target. So inflation is flat, and there's some acceptance of that. But that means that credit conditions are going to continue to tighten, and that growth has been overpriced, right? So I'm trying to think about this as the like longer term picture they're painting, which almost seems like they're going to accept some degree of stagflation. However, that's going to mean a severe contraction in margin estimates. So, you know, a lot of the growth being priced in right now is based largely on the idea of, you know, inflation coming down hard, substantially, as Powell put it, into the end of the year, and us seeing, you know, rate cuts, which will open up credit liquidity, and then, you know, growth has the opportunity to be funded, and he kind of rug pulled that whole thesis, right? The fact that he didn't repeat the statement about bank liquidity is interesting. I mean, banks obviously don't benefit. Like, the liquidity doesn't benefit from rates remaining at these levels. They only benefit from cuts, right? And with more rate increases projected further, it could mean they have to do more to stabilize their balance sheets for when those rate increases happen. I don't know if driving up equity markets any higher is really going to do it for them. They may need to start driving bond values up. So this combined with the Treasury, I mean, I got to think on this all a little bit more than my knee-jerk reaction, but I would say a lot of this is going to encourage a flight of capital to bonds. If we're not seeing yields drop already. What are yields like? A little bit on the 20 and 30 year, actually, are seeing the biggest declines today. The 5 to 2 and the 6 month up. So maybe a little interest in those longer duration securities. Any insight into the wild NVIDIA pump? No, not really. Upstart didn't pump as hard with it, which is interesting. I hope everyone made some money on their straddles. This was a good one. Even just returning back here to 43.80, if you started setting up your straddles last night or early this morning, decent positioning at, you know, even if mismanaged, you're break even on everything. So, I don't know. I've got to think on this a lot, because changing their forward projection is kind of another not a 180, but like a 90-degree turn from, they pulled back the narrative and now they're putting forth this narrative of continued rate increases. That was one of the most interesting things about the last 0.25 hike was that, they didn't put out any information regarding, the future pace of rate increases. And this kind of opens up the door for more rate increases a lot more. But it's also a known quantity, which adds certainty, right? There's another way other than mismanaged. I mean, even if it was like your first straddle and you just fucked the whole thing up, I don't see how you could have lost money. We went to 390, 43.37, and then back to 43.85, right? If you'd held a call or a put at any point today, you would have, anywhere near the money, you would have made money on it. Isn't that mega bearish? It could be extremely so. Yeah. I mean, anybody who wants to buy bonds knows that they can lose to the yield in the future. But maybe now they don't trust that the Fed is just going to stop at 5.6, right? Since the Fed is projecting not having a very significant effect on core PCE moving into December, right? The effect over the early front of this year, because inflation was so high last year, the year over year looks very good, right? But core CPI is basically stagnant, right? It's just flat. And if you look at the non-seasonally adjusted inflation, it's just leveled off. It hasn't dropped, right? Non-seasonally adjusted inflation is still like 6.84% annualized this year, up. So I mean, really, I think they're trying to see the effect of credit tightening due to the rate increases that they've already done. And they're trying to give that rate increase some breathing room, but inflationary pressures are making it so that they don't have a lot of time to do that. Right? So I mean, like, come July, they're going to need to make a decision. Right? With the pause year isn't good, I don't think, as far as, unless we do get a market correction, I don't think the pause here is good for stabilizing inflation in any way. I don't think rates were moved up fast enough, and I don't think they're high enough to have a significant impact. I guess we'll see how it develops. We know unemployment's moving up, and so we know, we may be facing a recession at the next meeting, right? And there's a really, I'm not wrong about that like 6-week inflation or recession projection is, I think still pretty spot on. And I think that the unemployment numbers that came in on the last unemployment report indicate that we will in fact see like, it's very, very likely that we see a somber recession. Inflation only needs to move up by unemployment only needs to move up by 0.1. And so I kind of feel like they're just pausing because the recession's going to happen anyway. Does that make sense? Like, the odds of inflation continuing to move up with manufacturing contracting across the board. I mean, why else pause here? And yeah, that's about 3 weeks from now ish. I mean, I'm not the only one who noticed, right? So if they're going to get their recession and they don't need to do anything to create it, they don't need to do anything, right? So it strategically it makes sense for them to do nothing. Then we see how the market reacts to an official recession, right? And then the Fed can react to that with another month of data. I mean, I understand their positioning, like monetary policies. It's probably a nightmare, right? Like you're dealing with data that's realized effect is 6 months to a year out from the time that you notice trends in it, right? So, and then you're trying to front run the effects of that data by making policy in the now that will affect, you know, the 12 to 18 month outcome beyond that. So it's not easy. I mean, I'm not saying they're good at it, but it's not easy to do, right? But if you know, if your goal this whole time has been to push a recession, which it has, right? Like, that's all they're saying, and in much more polite terms when they say price stability and inflation at 2%, they're just saying recession, right? And you know, he even backed down on the idea of a soft landing today, even though, you know, it could be still. The chances of that are slim because people's reaction to recessions are generally violent, right? So, they've got it, right? It's in the bag. If they want it, they've got the recession. If unemployment rises by 0.1, right? From now till September, we're in a recession. Well, that's a good question. That's a different question, Alex. You know, how much theta? The answer to that, I mean, SPX is overbought, so you know your positioning matters a lot. If you're trying to swing the peak of the cycle, then and we expect not a lot to happen into a recession by September, right? And theoretically that could come at any point in between now and then. So you have July and August unemployment prints, and then September's unemployment print, and then, you know, the 12-month rolling period changes after September, and unemployment would have to go a little higher in order to meet the SOM rule requirement, because our low from back here will have moved up, right? I mean, that if that specifically is what you're looking to target, then yeah, you would need, you know, December or Jan in order to be able to effectively manage just this time period. I don't know positionally if that's what you should be looking for. I still think the market right now is massively overbought, right? Even from a technical sense, you know, this nuts bullshit is due for a pullback. Anyway, we've got SLD, we've got, you know, liquidity getting tied up by treasuries. We have other factors besides the Fed here. And then, you know, the Fed's projection's not particularly good. You know, they're not cutting rates. They're not going to ease credit conditions. None of the growth that this upcycle is promising is going to be realized in the time frames that it's promising, right? And that's gonna scare investors, whether they're just pumping the market to shed or not. And if that's true, right? If this whole thing is just a risk off and we've moved up, you know, this 10% range due to big financial institutions taking money off the table, well, their narrative is going to break down, right? And if there's no one to hold the bags, right? Like if you don't have that narrative anymore, then things just start to sell. Unemployment matters a lot. Why don't you think it matters? Thoughts on price movement for the rest of the week? Well, the breakdown of the call positioning today was nice. I think we saw a breakdown in not only call positioning for today, but call positioning going into this Friday. Calls are now more expensive, so a lot of them taking profits off the table. With them taking profits off the table, that could lead to downside. I don't really think the market knows how to react to this. This is really tough. If you're long right now, you're in a lot of risk. If you're short right now, you're probably buried. So, I mean, if we're gonna see capitulation from one of those positions, I would say the long is more incentivized. They've realized profits. So you take them, right? You're up. The longs are up. They've made money. I don't think they're gonna sit around and find out if they're gonna lose it. NVIDIA, meanwhile, in a rush to realize 30 years of growth. Yeah, NVIDIA is going a little bit crazy right now, but I don't know if this is just a recall. It could be. There's a lot of sold puts at 420, so. How far can the bears take this? If we move down below 4250 at any significantly fast rate, I mean, you have so much. So, part of the leverage created to get this high was selling puts that are far dated, right? Not the long leverage wasn't very far dated, with the peak of long leverage falling out on like 721. That's less than 30 DTE, right? Well, almost less than, it's very close right now. It was like 34, I guess, or something. But the short leverage, they've been selling, the amount of Vega exposure that they're selling has been insane, right? And that inherently shorts the VIX, which we've seen, hit multi-year lows. So, VIX is low, uncertainty is high, and bulls are profitable. I don't think there's enough greed to go higher. Although you should never underestimate humans' propensity for greed, but narrator, there was more greed. But I mean, there's better opportunities for greed, right? You can start taking all these tech profits and putting them into bonds, right? Bonds are low. If you think the market's going to fall, right, or there's going to be uncertainty in the future, or rates are going to continue up, then bonds are great, right? So, like I said, it really puts a lot of emphasis on, our equity is the right place to be holding money right now. If you're truly greedy, there's commodities at all-time lows, right? You don't want to buy shit at the top, right? This is all topped. But there's no growth. There's no defensible growth. There wasn't any defensible growth when we were at 4,200. There really isn't now, right? I mean, you've got the top 8 tech companies, give or take, 5 to 8 tech companies, sustaining the other 75% of the S&P, right? And those are being based, the projections for growth on those are based on a very specific series of events, which JPOW just kneecapped. He said, we're not easing credit conditions. The growth you're pricing in is bullshit. We're not doing it this year at all, right? We're probably not going to ease credit conditions into next year either, because inflation's going to remain at these elevated rates probably till like 2025, right? So I mean, he made some pretty firm statements on the future of monetary policy. I mean, it is stagflation, but equity prices don't do well in a stagflationary environment, right? I mean, he doesn't have to say stagflation, right? Because there's some growth from GDP, right? There's unemployment's not high enough yet. But whatever happens, inflation's gonna persist. And the banks are already fucked. I mean, at this point, there's no rate cuts coming. There's nothing coming in to save them from their duration risk. So every month it builds, and they can't mark to market the securities without a loss. Meanwhile, Yellen's pumping yields, which makes it even worse. Would having a Latino Fed president help with any of this? Maybe. They could get rid of Waller and his skip bullshit. They even said the Fed was expecting losses in banks, and they're okay with that. There's going to be big losses. He said big losses. He didn't just say losses. I'm out of money to buy puts. That's because you already own them. Just deposit more. Don't bullshit me. I know your financial situation. Yes? No? No, SLD ends on Monday morning. They will just do a loss sharing thing like UBS and the Swiss government. That's how all central banks work. That doesn't mean there won't be losses. What about when they pull their risk back on margin? What do you think happens to zero DTs then? When the primes say, nope. Sorry, our CMBS portfolio is crashing right now. You guys can have 1-to-1 on collateral. If you buy 0 DT puts on a company paying a dividend that could potentially lower the price to get an out-of-the-money strike, does that get priced into the put contract? Are you talking about like the forward pricing of dividends? You don't have enough money to play like dividend arbitrage. The people who do that can hold the stock till it goes back up above the prior level. There's no money to be made with that play on the retail side. Not unless you're willing to tie up huge amounts of capital. I think that's what you're asking, right? Or are you just trying to find arbitrage in the contract pricing? You probably won't be able to take advantage of it in a meaningful way. Did he respond? Okay. What if they actually just make S&P 500, the NVIDIA 500, and the rest of the stocks can drop while NVIDIA holds 400? Soft landing achieved. So what possible catalyst is there for an equity sell-off? Well, prices are very high. That's usually the best one. Forward projections of growth and earnings are likely wrong. That's another one. There's going to be adjustments now to SOFR and SOFR swaps and their projected rates moving forward. You know, they'd priced out some rate cuts this year, most of the rate cuts this year, but you know, now it's looking like we're going to have a higher target rate this year, so that's going to need to be priced in. Obviously they're not going to take any risk, so they're going to be incentivized to price in that new, you know, projected structure for rate increases. You know, Yellen's still moving treasuries, right? And, you know, yields are rising, which it still incentivizes bond buying. You know, I think we saw a decent amount of bond buying today. And, you know, there's going to be, as she offers higher and higher duration on those securities, you know, I think we have a 20-year coming up. Those are going to become more attractive with reduced growth over the next 2 to 3 years, right? Especially if you think the price of the bond you're buying now is going to go up in the future. Don't just focus on the yields. Think about the bond price as well. I think it might be, I mean, even more short-term bearish. I think we might start to see some normalization of all this bullshit, if nothing else. I've said it a few times over the last week. A good correction lets me reposition for a longer time horizon if I need to. I don't know if I'll need a longer time horizon. Some of the things said today were, you know, in retrospect, pretty bearish. I don't see a lot of confidence in the market itself right now. I mean, usually we at least go grab the out of the money shit above like the collar or the straddle range, right? So the market was straddled at, you know, 43.75. Usually, even on a bearish meeting, you know, we'd see both sides, and no one's going back to get these calls that they left. There was a lot of them, 4,400 and higher, that are just dead now. They've been selling off. I think that maybe speaks more loudly than anything. There's a couple $1 billion in calls closed. Why keep the balance sheet the same? I mean, they'll have more buyers if the bond market goes up. Less work to offload it. I think an increase in quantitative tightening is still necessary, but they didn't do it this time. If they're going to get a recession, they don't need to do anything, right? All the bonds they've loaded up will go up in price. Why would they sell the bottom? Yeah, in contract pricing, maybe. As an individual, maybe you could find... I doubt you would. Dividend harvesting is really a game for the big boys. I mean, you've got to get the fill. You've got... I mean, the dividend needs to be priced in. It isn't always. So you could very well buy those puts, and then the dividend doesn't get priced in. You mean to tell me that after an extended period of below-trend growth, a dot plot that implies 2 more hikes and further offloading of bags isn't bullish? No way. I'm trying to do the JPAL thing and not making a bold statements, dork. I need to learn from the master. Are you ignoring my comments, or are you not seeing them? I didn't see them. I don't think. No? Well, for like the last 15 minutes, there's nothing from you. Maybe it's because you have anal capitalized in your screen name? Have you thought about that? Just maybe? I need to turn 10K into 40K in 2 months. What do? Get lucky? Don't lose it. Because then you'll have to turn 0 into 40K, and that's a lot of dicks. So I can only communicate via super chats? You could change your screen name to something that doesn't have anal in it. Why the frig is NVIDIA pumping like it's 1999? I don't even know at this point. But I sold 4035s earlier, and I might need to buy a call before close. This is ridiculous. Yeah, maybe not. Is full port Palantir a bad idea? Yeah, probably. This blows. Yeah, sorry. I can screenshot chat if you don't believe me, but yeah, it's you're not coming up. Get the 40K guy and the anal allergies guy together, and then what? When was Nvidia 350? No one can see it? Oh, okay. Is Nvidia the new S&P? It's almost worth more. Upstart was 34 like 30 minutes ago. What a beast. Yeah, it's Upstart is extremely impacted by Nvidia. Is there a significant short position on Nvidia? Probably, yeah. I guess I should have took profits on long dated puts today. Maybe. Or at least bought some short dated puts to take profits on. Ding ding. Yeah. Last push for those calls? No, all of those calls expired out of the money, including the 4375s. All the call side died today. Nobody closed shit when we were trading at 390, and then they all got murdered on the drop. Downey's over the night while the market absorbs today. We'll see. I mean, we've got we're in SLD. You know, we'll see how the market reacts. Can we gap below the 4300 puts? Yeah. Yeah, futures can move pretty hard overnight. They haven't in a long time, but they can. What's the OI looking like for OPEX? Any shift there? Let me update it again just to make sure. 1 second. Today was a weird fucking day. Looks like all the calls above 4,400 for this Friday closed. There's a little bit of interest left up to like 4,425, but a quarter of what there was. Oh yeah, I mean, I'll just show you guys on stream. This is all expirations. So pretty big collapse in call interest here. Oh, sorry, one sec. Not seeing it. Well, I can show you this morning's. Can someone ban the other gherkin? Hold on. This was all expirations this morning. Do I have it? Why is it not working? So the 4,400 level dropped by about half. From 64 to 33. The 4,425 level dropped by about 5 million, and the 4,450 level dropped. It's not the same pick. The levels changed. Oh, did I open the same picture? Hold on. I think I might have opened the same one. I'm not looking at the OBS. Oh, fuck it. I'll post it. I'll post it in the chat later. I'm not gonna try to find it again. I'll post it in the announcements. But the levels dropped over the course of the day. 4375 down by 75%. 4440 down by about 50%. 4425 and 4415 also down. Price is like kind of flat, right? So that shouldn't have affected Gamma too much. We ended the day up 8 basis points. So yeah, so basically at open. Crypto drilling to the earth. Cool. Closing Gamma super low. I know. I opened the same picture twice on the stream. And then the other one that I tried to pull off the fucking thing didn't save. I don't want to deal with it. Now that the NVIDIA pump simulator is over, did all your awesome outros come from? Wait, what? The people made them. BTC isn't drilling, it's a SR? Okay. You mentioned sold puts at 420 on NVIDIA. Did you mean sold calls, which could be blown up now? No. I didn't. When did I say sold puts? Sold calls. Sold calls. I don't think I said sold puts. There were sold calls on NVIDIA at 420 earlier. I know, because I sold my spreads above them, and my spreads are now in the money. QQQ up 73 BPS, because why the fuck not? Yeah, I mean, we're definitely seeing more pump in tech. Although most of that 75 BPS was already realized this morning. Crypto total market cap down 1.6% in 10 minutes. It's not trivial. Okay. I'll look at it. Yeah, we'll see what happens overnight. I think it could be interesting. There's a pretty decent pullback in the call position. That doesn't mean zero DTs aren't going to come in. I don't trust it until we get below more important levels, but it's a good first sign. Yeah, NVIDIA's still pumping. All right, guys. Thank you so much for tuning in. Yeah, we'll see what happens tonight, especially overnight into tomorrow. Thanks for tuning in, and I'll see you in the morning, guys. Have a good one.
Kinney's Mayonnaise is a proud sponsor of Pickle Financial, so when you get a hankering for some creamy, delicious mayo after a long night of snorting, sweating, and pacing, grab some Kinney's.
It's yours?
No,
My mother said she found it in your closet.
I don't know. One of the guys must
Must have what?
Look, Dad, it's
Where
not.
did you get it?
Dad,
Answer me. Who taught you how to do this stuff?
You, all right? I learned it by watching you.
Parents who buy weeklies have children who buy weeklies.
Just some pickle theme fuckers, not a cult, no. Like them AMC suckers, not a cult, bro.
Riku!
Sit, Krian, sit. Good dog.